Me too.
Yeah. Just get started. I'll throw the presentation up as we go.
Well, thank you everybody for joining online during these really strange and unusual times. I'll just start walking through our deck. So I just wanted to remind everybody that, typically we meet in person. We meet at Creed's coffee shop down on DuPont. If you're in the area, they're still open for business. So, please try to support a local business. They're still doing their dry cleaning because that's been deemed essential, and their food and coffee are available for takeout. Next thing is, who are we exactly? I know that there's a lot of regulars on the call, but so we're basically a real estate investment firm. We help take people from education, which is things like what we're doing today, advisory services, and we bring them all the way through to purchasing the investment properties, doing construction if that's necessary, and then doing property management on it if we need to. That encompasses kind of the four major parts of the business. We've been doing this for a long time, and there's a bunch of clients on the call as well tonight. You're more than welcome, if you're new, to connect with existing clients to understand what it is. Don't just listen to the talking shaved head. Listen to connect with others for that information. So moving on, Matt.
Did you talk about this?
No, but we can. So anyway, we're investors ourselves. First and foremost, actually, we're investors ourselves. We all started out as investors, and we built a business out of that after the fact. We became real estate agents after the fact, but we're all originally real estate investors. I'm a computer science background, maths and engineering, and we had traditional 9-to-5 jobs, started investing, and realized this is really where our passions lie. So that's why we have this business today. Any questions about that?
Yeah.
Anyone want to add, Matt?
Yeah, I mean, we're real estate investors. We are, realtors. You saw the different areas of the business that we are able to help our clients in. But we walk the walk. We talk the talk. We're also one of the biggest reasons that we feel like we're capable and entitled to help you is because we're more than just agents. We're certified real estate investment advisors. We were nominated for real estate investing awards. We have our own personal holdings. We've helped a lot of people. That number of investors educated is way off. We're up over 2,000 now. And same thing for that number for real estate invested for clients. These are all outdated numbers. But the point is, we helped a lot of people, and we can help you too. Okay, so yeah, we talked about this one.
Cool.
Okay. Yeah.
Just to touch quickly on this, we do normal stuff, and actually, this is more important now than ever before, because if you are in the middle or considering a personal residence purchase, because your primary residence is such a key part in your investment portfolio, and the conditions that we are investing in these days are changing so drastically. So basically, I'll give you a quick example. Right now, let's say if you were to buy a house and you may be, let's say, closing with Scotiabank, you were going to get a HELOC on that house, and that HELOC was going to fund your investment property, I would be advising you to find a different lender, because right now, for example, Scotiabank is not allowing funds coming from HELOCs to be used on investment properties. So it's little stuff like that which will make a huge impact to your ability to grow your portfolio or to invest at all. Anyway, let's keep going on to the next slide then. So we like to put up this slide because this is really, companies have mission statements. This is like our mission vision. We wanted to help cut through all the crap, because when we were starting as real estate investors ourselves, it was really difficult. And, I wish I had somebody kind of to help me out through all the different steps along the way, because there's so much to know. And each area, we were talking a little bit earlier about construction, for example. Each area has so much depth to go into. That's why, the team is the way it is, because we needed each other's help, because we have expertise in all different areas as well. Next slide. Just a reminder for our active clients that we have the mastermind group. I know there are some clients who may be a little bit shyer. That's okay. You don't have to actively participate if you don't want to, but it is or they feel maybe that they're not invested enough. They're beginning investors, but that's fine. You know, the mastermind chat that we have for all our clients is a safe space for people to ask questions. There's no dumb questions. Like, we're all there to help each other, and we all started at some place. And hopefully our clients who are on the line and who have been working with us through the years have found this community to be very helpful.
Yeah, and actually we're going to have a couple of people actually talking about their experiences, investors, seasoned investors now, and maybe they can give some insight as to how this has been of benefit to them as well. Oh, I forgot to add the third face.
Yeah, actually, we're gonna have Chris, Florence, and Vinay speak later on. But these are kind of just some extra friendly faces who are willing to chat with with people who are new to our community, to get up to speed on what investing in Toronto is like, the kind of the good, the bad, and the ugly of it, and to hear from people who are in the midst of it right now.
There should be a third face up there. you'll see his face a bit later.
Yeah. I actually removed the slide. I don't know why it's still here. Because the ambassador idea was like we'd actually have people in the room, but there's no people in the room. So
you can private message them.
Yeah. And just a reminder that we have a complimentary 60-minute advisory session. And basically what we do during this advisory session is we look at your current situation and where you want to get to in terms of investing, and we build you a plan as how to get there. I'll listen to, or whoever is doing the advisory session will listen to what your goals are, and then put ourselves in your shoes and talk about what those steps would be for you to get towards your goals. Hopefully people found it a very useful 60 minutes of their time. And I think it's always great to have somebody, with a bit of experience in investing, but also a different perspective to look at, what you're trying to achieve investing, and, how we would help you, or how you could help yourself get there.
Don't underestimate this. This is like, we see this as our core competency and our differentiator. Really, I mean, if you wanted to start investing, who do you talk to? You might talk to an agent, you might talk to a mortgage broker, maybe your financial planner, but no one really will sit down and holistically be able to help you achieve and help you build a plan to achieve your goals. We really strive to understand what those things are. In our real estate vernacular, we call this our personal beliefs. We really want to truly understand what you want to achieve, not just in context of real estate and investing, but sort of those life goals as well. And as much as fluffy as this all sounds, like we said earlier in our sort of preamble, before we started our presentation, I'm an engineer. I hate fluff. All the fluffy crap I usually toss out the window. But it actually makes a difference in your investing journey. And if it doesn't, if your investments don't match your lifestyle goals, then maybe that's not for you. It's not always just about highest return, not just about highest ROI. There's other things to be considered as well. And this is where we sort of want to understand that holistically before we, undertake the journey of, okay, let's go buy that property, right? Okay.
Yeah, because it's more about running a business than it is about investing, right? Real estate investing is like having your own little business. Anyway, I wanted to talk a bit about the market. I usually do this every month. This is, kind of the same old stuff, but obviously COVID is upon us, and the data is a lot more interesting now. So let's start with sales volume. So, the bar that you see there in orange is the sales volume for March. April data isn't out yet, but there have been some mid-month reports. So March was a mixed bag. Like, if you were active in the market in March, the first 2 weeks were crazy, and we were, I think, about 30 or 40% sales volume increase over the previous year, and it was looking like it was going to be a super, super hot spring market. Then the coronavirus hit, lockdowns happened, and basically the city shut down. So, I mean, the world has basically shut down. Interestingly enough, it was not as inactive as I think a lot of people anticipated. About 4,000 homes have actually traded hands during the lockdown. So much for self-isolation, I guess. But real estate has been an essential service, and I understand there are people who have to transact. Like if you were in the middle of a property, closing on a property, or you had sold your house and you need to buy a place now to move, it is essential. Otherwise, you're kind of without a home. Second 2 weeks of March definitely slowed down, but April is really where we have felt the full effects of coronavirus, with pretty much all the lockdown fully happening throughout April. So the mid-month market reports are showing a big decrease in sales volume. So sales, and this is not to be confused with pricing. This is just the speed of transactions, right? Are transactions actually happening? And the first half of this month is down almost 60%. And this is actually what we expect to happen. Basically, places aren't taking new listings right now unless they really have to. Showings are very difficult to do. If you can imagine, people don't want, even if you are willing to, and you have to sell your house, people don't want people coming into their house right now, potentially spreading the virus. So sales have to be done virtually or showing after an accepted offer. It's become a very strange place in terms of showings. A lot of virtual tours are happening. So people, walking clients through virtually with a camera on a property. But most people are just waiting. Like, really, it hasn't been that long. So unless you're in a position where you're forced to buy or sell, people are waiting right now, and they have been in the first 2 weeks of April. Now, where we're really seeing an impact in sales volume has been on the condo side, and subsequently, we've also seen an impact in sale prices on the condo side. Condo sales volume is down almost 70-something% right now. Especially in the bottom end of the market, which is where we had seen the massive increases, and this is now where we're seeing a little bit of a correction. I think that kind of covers sales volume.
Can I just jump in? Is Ed with us? Ed, you there? You're muted if you are. Okay. I know we're talking about condos. I know you said you were seeing the biggest impact on which type of condos and which buildings.
The downtown condos have definitely taken a hit both in the rents and the prices.
Which buildings?
A lot of the buildings which historically were Airbnb condos are being put out to rent, and they're having trouble getting rented out during these times. Also, going for sale.
I don't think we can hear you very clearly.
Let's see. Is this better?
Yeah, a bit better. Go ahead. Yep.
Yeah. So a bunch of the condos in downtown, which were historically used for short-term rentals, have taken a huge hit. Not only have they decreased in value by a little bit, 5-10%, we're seeing decreases in rents. Those properties that were short-term rentals are trying to be listed as long-term rentals to kind of,
bridge them.
Bridge them through these tougher times, but because of the influx, it's also quite difficult for these units to get rented out. I think over houses and also some of the condos that were not meant for short-term rentals, the ones that have, for example, ICE condos 300 front. If you actually just take a look on MLS or Realtor.ca, you'll see hundreds of listings, not only for rentals but also for resale. Not resale market just yet, but for that actual, at least a rental market.
Yeah, so we've actually, you can see.
Go ahead, Matt.
Yeah, I mean, we've actually pinpointed the actual buildings. We know which ones are being impacted because we know which ones allow short-term rentals. Those are rentals less than a certain time period, like 30 days or something like that. And those were popular because those were popular. People who ran a business using Airbnb, they would rent these condos from an owner. They would then they would outfit it and then re-rent it out on a short-term basis using Airbnb, and then take the spread. And that spread was quite large historically. You know, they could take a long-term rental and make 50, 100% more rent. It's an active business. Obviously, it's a lot more work, but that became a business for people. And now those people are getting squeezed very, very heavily. And so anyway, I think that's what Ed's referring to. So, you know, the ice condos at 12 and 14 York, 300 Front. There's a few other buildings that we know of that are being heavily impacted. So not everyone is being impacted in the same way. I guess that's what we're trying to say. Even, you know, we can say generally speaking, condos are being affected. It really, there's a caveat there. There's always an asterisk. We need to understand what that asterisk is. Okay, Ming.
I was just to say, you know, we often have been asked about short-term rentals and, you know, what is our opinion on short-term rentals. We have said in the past that yes, it is a great way at lifting cash flow. It is, you know, a great supplement, but you should not base your primary investment strategy around short-term rentals, because even before, you know, COVID was in everybody's vernacular, short-term rentals were too new, and they're subject to kind of the whims of policy, which meant that at any point the government might say, you know what, we're shutting down short-term rentals, we're capping short-term rentals, or something sweeping could have come across which would have killed your business case. And so we were always advocating, you know, for people to be cautious with short-term rentals, have them as a supplement, but your property should still be able to hold themselves up as regular rental properties. Yep. Anyway, let's keep going. Let's go to the next slide. Going?
Yep. New listings.
Yeah. So anyway, new listings here. We don't have the April data, but if the April data was on here, you'd see new listings down significantly. I'm looking forward to getting the full April data, because while demand has decreased because people are just, majority of people aren't investors, by the way, they're just regular home buyers. While those regular home buyers are just kind of waiting it out, the amount of people who are listing has also dropped. So there hasn't been a fundamental change in the supply-demand curve, more than it's shifted, the whole thing shifted downwards. So, you know, both supply and demand have gone down, which is, you know, if you go to the next slide, Matt, what we're really seeing is reflective also in pricing. I think a lot of people had anticipated to see major changes in pricing, but the reality is there hasn't been. The mid-month market reports are only showing about a 1.5% decrease in average home sale prices. And we know this is reflected mostly in condos already at about 5 to 10%, as Ed mentioned, which means that some areas are actually continuing to rise in price. Now, this is not to say that this is going to continue on through April into May, June, July, who knows? But for, I think that a lot of people are seeing some headlines and thinking there's a lot of doom and gloom. Volume can change very quickly, right? Because there's interest or there's not interest in the market, and therefore transactions are happening or not happening. But actual value of properties, that is not as elastic. And if there is going to be a decrease in pricing, it's going to take more than a couple of weeks, 4 or 5 weeks of COVID for that to make an impact pricing. A couple of RBC, Royal LePage, and I think Zoocasa brokerage, they're all anticipating that we'll see a dip in pricing, but that will be fully recovered price-wise by the end of the year. And I kind of agree. I think it will depend a lot on how long this lasts. Like if we're talking about, some semblance of normality coming through and May, maybe early June, then you know what? I do agree with them. If we're talking about extended or waves of this happening, then we will see a price change. But I don't think it's going to be as fast and rapid as I think a lot of the the scary headlines make it out to be.
So just so you know, just so we can illustrate what Ming's saying, basically this is supply and demand, right? And when we increase the supply, this happens, but if demand is static. But actually we're decreasing supply and we're decreasing demand. This is actually, the equilibrium is still there. And that's why we're not seeing huge swings or decreases yet in average sale price. It may come.
One thing that,
but sorry, go ahead.
I was just going to say, one thing that's also interesting is where, like, we know that large job losses have happened, but we're starting to get the data as to where those job losses have actually been occurring. And the majority of job losses have been happening amongst, kind of the young, people who are just entering the market, fresh out of university, those contracts have potentially been canceled, and part-time workers, right? And those people are not actually home buyers in Toronto. They without COVID, they wouldn't have had the buying power to be buying a home in Toronto. So, those people are impacted right now. If it remains just, it's short term and it's just those people, then, the actual home buyers haven't yet been impacted. Now, if this carries on, then it's a bit of a different story, but this is what we're seeing right now.
Yeah.
Cool. So, yeah, let's quickly go through this because I think looking at the detailed data is interesting, especially, with COVID stuff. So, those of you who are familiar with what we do, we look at neighborhood by neighborhood and we look at the home price index, which is like for like properties. That's like a 3-bedroom detached home and comparing just that instead of looking at averages. So if you skip ahead a couple of slides, Matt, to the actual graph that we have, I think slide 17 or 16. Yeah, one more. So this has been updated with March data. And, go back one. The actual, no, downtown's, you're at the uptown stuff. Go back 3 slides.
Okay.
Yeah.
Here?
So, yeah. So if you look, we have the March 2020 data in here. And I think April is going to be the one that's going to be, the most interesting. That's when we should see a leveling off of these. But in the downtown core, in the places that we talk about over and over again to invest, and we're looking at these single family homes, prices are continuing to rise, and they continued to rise even in March, which I think is important. So a lot of people, there's some people who are in the middle of closings right now. They're a little worried about their refinancing. The market data has not shown significant price changes yet. So, if you're in the middle of a refinance or you're getting financing, now is a good time. Don't laggard on it, because if we do see pricing correction happening, let's say a month, 2 months, 3 months from now, that will impact your financing or refinancing ability.
Yeah, so I'll just jump in here. Anecdotally, so myself and a bunch of our clients have chimed in on our Volition mastermind chat. A bunch of us are doing refinances. I literally just did one, and prices, the appraisal values that are coming in are reasonable as of right now. I don't know what that's going to look like in a month or 2. Get your appraisal done. Get it done now, because I don't want to speak on behalf of like mortgage brokers and lenders and all that stuff, but it doesn't seem yet that the lender has given instructions to the appraisers to scale back their appraisals. They're coming in where we expect them to, give or take. Yep. So this is a good time to do them. And just as a note, appraisers aren't going through houses anymore. So what they're doing is they're doing virtual tours. They're asking you to send them photos. what we've advised our clients to do is put together a very comprehensive package, all the comps, really a comprehensive feature sheet and a comprehensive summary table so that you can hand this package over to the appraiser and you've done all their work for them. I've done this, a bunch of our clients have done this, and their valuations are coming in pretty good right now. So do the extra 10% work and you might be rewarded.
Yeah, it kind of, you know, gives us an unprecedented ability to influence the appraisal.
Influence the appraisal.
True.
Yeah.
Before
gives us
we
a chance to
didn't have that
embellish.
ability.
Yeah, no, like
Well,
I'm not saying lie.
whatever words you like.
Sure.
But you
no,
know, you take good pictures, right? Like
I had
show your property in
professional
its best light.
photography. Yeah, I sent professional photography photos to the appraiser, made the place look amazing, better than it actually does in real life, and it helps, right? So
yeah, for sure.
Anyway.
And like professional photography is a couple $100. You get an appraisal that's, you know, an extra 100,000. That has totally paid off, right?
Yeah.
Cool. So that's it for kind of our. Oh, sorry. Next slide.
Here, this.
Yep. Keep going.
Okay.
And let's look at the data everywhere else as well. So not the downtown core. So this is like next slide, Matt. This is like your.
This is the areas these are the areas not to invest in.
Yeah. So skip ahead 2 slides. Yeah. So like outside of the downtown core, basically, and this is what we're seeing now. You know, I think what's interesting here with the March data in, there is still a bit of price recovery happening in these areas. I'm really looking forward to seeing April data and seeing what has happened, because we know average prices are starting to come down, but we don't have the detailed data yet. So if we're seeing average prices come down, I'm going to assume that this is happening mostly outside of the core. This is recorded, so we'll see next month how accurate I am. Let's go on to the next slide, condos. And condo prices have continued on a tear through March. Again, as we said, you know, when we see the April information come in, I think we'll see a bit of a correction in this.
Join the meeting.
Okay. So let's move on to our expert panel then. Are Lawrence, Chris, and Vinay on the line?
Yeah, so just to preface this, this is a continuation. We had our full day crash course quick start event on February 1st. We ran out of time because I spoke for too long. And I'll try not to do that now. That's why I'm letting Ming speak instead. But anyway, we did run out of time, and one of the areas that we had to cut short was this panel. And the feedback we got was that they loved the little tidbits of this panel that they got. It was supposed to be I don't know, 45 minutes or something like that, and we only got them up there for 20. So we wanted to give people more of what they wanted. They wanted to hear more from these guys. So these guys are
Join the meeting.
Clients of ours. They've become great friends of ours, and now they're going to be friends of yours. So yeah, so I'll let Ming sort of kick it off, and I'm going to stop the screen share so that you guys. There, we're back.
Yeah, are you able to show Chris, Vinay, and Flo? I don't know if we're able to.
I can only focus in on one of them at a time. So
okay.
Why don't you start speaking, and then I'll switch to them as I need to.
Cool. So I will make this more directive then. So thanks a lot, you guys, for participating in this. Let's go through kind of one by one. Just do a brief intro about yourself. You know, if you like romantic walks on the beach kind of thing, and also talk about a bit of real estate. Let's kick off then with Vinay.
All right. My name is Vinay Kansan. I work in performance and analytics in finance. To kind of explain what that is, if any of you saw that movie Moneyball with Jonah Hill and Brad Pitt, they kind of explain sabermetrics for sports stats. It's not like, oh, how many points did he score? That's easy. It's how many points did he score in certain situations, and trying to find analysis and trends and stuff like that. I do that except for hedge funds, mutual funds, and pension funds. So yeah, I work in performance. I'm originally from Saskatchewan. Grew up there, moved to Toronto after going to Western for university. Been investing in Toronto now since, my family has been since 2008. I have since 2014. Met up with the Volition guys about a year ago. And yeah, I was looking more for services that they offered as opposed to my other agents and investors, because I started to see some trends and some weaknesses that I figured in my real estate portfolio. Unlike a lot of real estate investors, I actually don't have any special attachment to real estate. I don't think it's this magical holy grail. I don't think it's the be all end all. But I do feel with the proper, I should say, due diligence and effort, it's a very good thing to have in your portfolio, along with, you know, your stocks, your bonds, private investments, and things like that. And so when I was looking for certain opportunities in real estate, I came across the Volition group. You know, I vetted them, and within, I think it was 3 weeks after meeting you guys, we basically bought a place and started a full gut.
Yeah, it was fast.
Yeah.
Vinay and I were chatting on the phone one day, and then the next day it's like, hey, I'm buying a place. And it was a full gut legal triplex project as well.
It might have been a bit faster, Vinay, but I think I didn't return your phone call for like a week. So,
And this is why we don't give clients to Matt.
Yeah.
So,
if you try to reach us and you don't hear back, then that's probably why. It's on me.
Yeah. Cool. Let's flip it over to Chris then.
Hey guys, hope everyone's keeping safe and healthy these days. Yeah, so I guess for myself, just a bit about my background. Eldest son of two siblings. My parents are immigrants. I started really just coming to Volition's meetups really just to understand more about real estate. My background, my family, no one believes in real estate. It's, as I'm going to quote my dad here, Chris, debt is bad. Like he would just continuously just drill that into my mind like year after year. So I would never buy anything. I would just be like, oh, okay, I'll just wait till this bubble crashes. And he's like, good, listen to me. I'm wise. So literally that would be his voice in my head. So I just realized, like I love my parents, I have a ton of respect for them, but when it comes to financial literacy, I thought I had to go somewhere else for that. So that's the main reason I started coming to the Volition meetups. It was just happenstance, just looking on Meetup, found this interesting meetup, happened to work out with my schedule. I actually met Flo, the other guest panelist. It was our first meetup for Volition. It actually wasn't called Volition at that time, but it was my first meetup real estate wise. And I thought, okay, these guys, seem to know what they're doing. Like they seem pretty intelligent, pretty humble guys. So let's come back and see if I like what I hear. Then I continued coming, and yeah, everything really, honestly, they really walk the talk. They're very honest, very transparent. Like I've never had any issues with them. So yeah, I mean, for myself, I started coming when I already purchased a condo in Regent Park at the time. So I was renting out my second bedroom to my roommate and basically paying down a ton of my mortgage. So I thought, how do I scale this up? And that's sort of where, when I went out to Volition meetups to learn more about, triplexes, multi-residential, how do you kind of 10x this concept, right? So honestly, like I'm just very grateful for the whole team. All of them they got all their different strengths and niches, and but as a collective, they're really great guys, gal. Just very happy to have met them, and yeah, I mean, I'm hoping that later in our discussions, like we could just have more organic Q&As about other pieces as well. But I think for me, the main thing was just getting educated for myself, because again, my main influencer in my life, my dad and my family, they didn't believe in real estate. Like none of them like invest at all. So I just really didn't have any good role models to kind of model any behavior off of. So to me, it was just more, okay, I need to surround myself with people who are successful, who've done it, who can be a positive influence on me. So thanks again, Matt and the team, for just being that model for me.
Well, thanks, Chris. Thanks for the kind words. And, you know, I remember early on in our conversations, we related to each other so well because we came from similar backgrounds. Immigrant parents, parents who didn't really believe in what it is that what are in this endeavor. You know, it was similar to you in having to kind of overcome that, you know, being kind of the single biggest influencer in your life and having to actually go against the grain a little bit. And you and I had a lot of conversations about that, how to sort of get your dad on board and how to, and how that, you know, how that your relationship with your dad actually changed over time. And then how it actually became, real estate actually became the thing that brought you guys together in a way for you when you guys started working together on certain things. So that was really cool too. But anyway, yeah, thanks for those kind words. That's means a lot.
Great. Yeah. Thanks, Chris. Let's hand it over to Flo.
If she's there.
Lawrence, are you there?
Wake up.
She was there.
I feel like we need to WhatsApp her. Okay, why don't you get going?
Let's dive into the first question then, and
I'll message her.
We can catch up with Florence in a bit. So Chris, since we're with you,
I see what happened there. Okay, you can hear me now, right?
Oh, there we go.
Oh, where'd you go?
It's very helpful to have an assistant who's camera shy sitting next to me, telling me to unmute my mic.
Are you sure you just didn't wake up from your nap?
There may have been a nap or some food preparation involved. I think there's an accusation about Uber Eats as well, because I am one of those millennials or Volition clients apparently. So I would classify myself as an old millennial, and I think one reason why I was asked to speak at this panel in the February event was that if someone like me can do it, any of you guys on this call can do it. And this panel, I think, is a combination of encouragement and to also hear directly from clients who have worked with Volition. You know, it's a plug, but at the same time, I often, I come from professional services, and I have no issue paying for good quality advice and to work with really great people because they are so rare to find. And I think a couple of reasons that I stand out from the typical investor is that one, I am doing it myself on one income. You see a lot of investor couples out there, and I see Chris nodding, and because he's also, you know, kind of going at it alone. It's really incredible to have support and to learn from people that are further ahead in the journey. Especially since, you know, when it comes to things like mortgage qualification or decision making, there's pros and cons, right? Because you can make decisions by yourself, which is great, but at the same time, it's not as fancy as you go to the broker and go, yeah, this is my salary, and they tell you you don't make enough. Matt also tells me that every time I talk to him.
Florence, her executive MBA doesn't make enough.
Executive MBA is very expensive. And that was a good segue into something to a little bit of background on what I've done. In 2013, I moved from Vancouver to Toronto, had a 1-bedroom condo, and scaled over the course of the last 6-7 years, 3 years being a Volition client, to having 2 houses and a condo, essentially in downtown Toronto. So by the end of the project I'm currently working on, it'll be 7 doors, including one that I'm living in myself, until I do the next project. I worked so I work in BMO now, one of the big 5 banks, and I have an HR and consulting background. So I did that in Vancouver and made a lot of sacrifices to get to where I am today, starting from, you know, having to live with a roommate, and before that living with parents to save a lot of money at home. And then from there, you know, scaling back on travel and a lot of the goodies that I used to buy, including nice bags, and recognizing putting money into assets will help along the way and giving me choices in the future. I think as Matt noted, I did my executive MBA with Rotman in 2017, a huge plug for that program, very transformational. But it was difficult because at the same time, I was also working full-time in my quite demanding job. and also working on a renovation, my first triplex purchase with the Volition team. And it was a complete cosmetic renovation. Some of you guys may recall touring it as a project was being completed. And now I'm working on a project where I'm taking a single family home in the downtown area and converting it into a legal triplex. So Ming, back to you to on to the next question.
Cool. Yeah. Thank you so much for the background info. So since we're in EU right now, Florence, if there was, one piece of advice that you could give yourself when you started investing, what would that piece of advice be?
Yeah, and I'm glad we started with this because I went back and dug up my notes because I didn't know the panel was first. Thanks for the heads up. Appreciate that. Frantic the answer to the question as I was reviewing what the heck they were. I actually turned your question for the panel and it said, who cares about giving me advice, right? It's actually about what I experience and what advice investors on this call might benefit from, or potential investors. And I broke it down into success factors. The key one is to take action. And to take some risks. The things that stood out to me is making the right choices at the right time, even if it doesn't feel right. And the advice is, especially around mortgage financing, to go when you qualify or when the stars align. Let's say there's a property that's 90% there and you can buy it, like just do it, because stuff changes so quickly that like right now people are trying to refinance, as Matt said, and you can't necessarily do it. The other piece, and I'm throwing in sort of a second thing here, is integrate different perspectives. The whole point of working with the Volition team and the people that they have relationships with is to learn from the, different pieces of advice, right? Like an example I came across earlier on is asking Matt and Sam about how they handle hydro for tenants. Do you take the hydro for triplex and split it into, do you include it in the rent or do you not include it in the rent? And hearing about the pros and cons of each and then making a decision from there is something that I couldn't have determined on my own.
Yeah, and like just to call out, I think what you're saying there, Florence, because I think they're two actually really excellent points. One, the perfect investment doesn't exist. Like there's no 100% house out there which ticks all the boxes, right? There are a lot of, I don't want to say a lot, but there are 8 out of 10 and 9 out of 10 properties that with your, skill and your network, you turn into 10 out of 10s, right? But you can't just go and buy a 10 out of 10. So that action is important, and that action on not expecting it to be a perfect property. And then the second one, which is really good, is essentially community, right? Like whether, and your network, whether that be, the people who are talking up here now or other people in the Volition investment community, because you can only Google so much, right? And it's only going to give you generic answers at the end of the day. Everybody's situation becomes unique after a while, and you need that community there to help you solve that problem. So cool. Thank you so much for those answers.
Yeah, I just wanted to add a couple of things. So yeah, definitely like the take action. I mean, that's definitely a big part of it. For sure. And I, probably the kind of the add-on to that is going to be, the analysis paralysis component. I think Chris usually likes to talk about that one. But the part that I want to zero in on is the risk. Like, she said like, even if there's a risk, take the risk. Just to clarify, I think what that actually means is measurable, identifying the risks and mitigating those risks, and making sure that those are measurable risks, and making sure that the reward outweighs the risk, right? So when you start talking about, our investment model is heavily based on a cash flowing business model, and in great areas that have great growth potential. They may not be the maximum growth, right? Maximum growth you might find in, Markham or Richmond Hill or wherever. Everyone was always looking for maximum growth. We're not looking for maximum growth. We're looking for sustainability and resilience in our portfolio. And no better way to illustrate the resilience to me, the performance of one's portfolio is not when things are going well. It's how is your portfolio doing when things are absolute shit.
Like,
right?
let's say like there's a pandemic going on.
Let's just say, right? And I think, I think it's a testament to how we, the Volition community invests, because we haven't had a lot of horror stories. We've had just, occasionally, sure, there's going to be the occasional person here or there, but as a whole, the business model is extremely resilient. And we're, across, I don't know, there's maybe 50 or 60 people in our Volition chat or something like that. And we're not hearing a lot of the horror stories that I know people are experiencing in a lot of the smaller towns, people who are looking for maximum cash flow at the expense of their tenant profile, things like that. So anyway, I just wanted to kind of talk about to clarify when Florence was talking about risk, because I think we were talking about the same thing. I just wanted to elaborate on a little bit more.
Cool. Let's pass it over then to you, Vinay. If there was one piece of advice, you wish you could give your early investing self, what would that advice be?
I think it's something you covered earlier, where you said, don't expect a complete perfect property, because especially in a market like Toronto, or honestly, almost anywhere in Southwest Ontario, it's very rare that you're going to find a perfect property. Real estate is being very hot and very popular for people to invest in. So if one exists, it's probably getting snatched up by a much more experienced investor if you don't know what you're doing. When it comes to investing in lifestyle, I would say I'm almost bipolar in that sense. I invest, I would like to almost say, hyper aggressively. However, lifestyle-wise, when I got my condo back in 2014, I didn't buy it thinking, oh, the market's going to appreciate so much, I'm going to have all this cash flow. I bought it because I knew if I had one roommate and I, for some reason, lost my job and couldn't get another one and had to work at McDonald's or Amazon warehouse for minimum wage, I could still make all my payments and live. Like I have a very, very low burn rate in terms of my monthly expenses on what I'm actually happy and comfortable with. Now I go over that because I like to eat out and things like that, but to save money can easily drop down to living basically below minimum wage and covering all my expenses. So because of that, I invest generally extremely aggressively. In fact, Edward can say, like, even when I'm not looking to buy a place, I'll still be messaging him plenty of properties to, get his opinion on, or maybe even make a move. I told him when we first met, like, all right, maybe over 5 years, we'll do 2 or 3 of these. We're coming up on knowing each other for a year, and we're almost finished one. We're closing on another one in June, and now we're getting the war chest ready for another one in November. So basically 3 in a year and a half. Same thing when it comes to condos or anything like that. I invest hyper aggressively. So what I would tell a lot of people is know yourself. I'm going to steal this from someone. I don't know if you guys know who this is. His name's Mike Rosehart. But the 3 keys of kind of achieving financial success are maximize your earnings, minimize your expenses, and then maximize your return on investment. So get the best job you can, get a side job, earn as much money as possible, drop your expenses, and then really maximize your return. So where Volition comes in is with the proper guidance, you can mitigate a lot of the risk that real estate involves. So make sure if you choose to sign up with them, you have everything ready. You know what you're qualified for because you've spoken to a bank and a couple mortgage brokers. You have enough savings. You know what your budget is. So if you tell them that, hey, look, I can do a $700,000 house with $300,000 in renos, right? Or your capital, make sure you know exactly what it is and what money you have, because at the last minute, especially nowadays, when we got the place that I think Edward's going to show you on a virtual tour later on, it came in, we thought we got it at a good value. The bank was like, all right, yeah, even though you're qualified for a mortgage of, let's just say, for example, $2 million, we'll lend you $2 million, but we think this property is only worth 1.9. So you actually have to come up with 100,000 extra down payment. And they told us that, a couple of weeks before closing. So you have to have a good contingency budget. What ended up happening? Less than 2 months later, a similar property down the street, virtually identical, sold for, say, 2.5 million in the exact same condition, basically. So the bank was just being very conservative with their value, but that doesn't matter. With 2 weeks to closing, good luck trying to find another lender or something like that. So just make sure you get your budget, your plans, your contingency, all of that stuff lined up, and you know exactly where you fit. And then if they or you find a property, then go for it. But know your numbers exactly so that you don't bother thinking, oh, well, my budget's 1.1, or maybe it's 400,000 or whatever it is. Don't start jumping up that budget just desperately trying to get in. Because, unexpected things can happen. Right now we have a pandemic. So financing, doing refis, HELOCs, all of that is getting tightened up. And in fact, mortgage rates did dip for pretty much a week. They crashed. And now they're shooting back up to higher than they were almost before January. So I would just say, make sure you have everything ready, get your credit score, spend a bit of time doing tips and tricks that make your credit score better for the next couple months. See what lenders, some will count potential Airbnb income. Maybe not right now, but they were starting to. Other banks like Scotia, they do not, right? So just make sure you have the exact idea of what you can spend, what you can do in mind, and then be ready to pull the trigger as soon as it happens. Because there are still sometimes good properties that come about, but they go right away. It's like the rental market. Now, obviously, it's a little different with tons of Airbnbs coming online, but I would tell my friends, like, hey, before, or even me, before you're going to go rent a place, get a good idea of the area, get the history. So that way, when a good deal pops up, you can give your application, your post-dated checks, your references immediately on day one and just get it. Because good deals come up, but they go very fast.
And to that point, they're still going really fast. Go ahead, Ed.
I was going to say, Vinay, I think you're very opportunistic. It's just, I think both of us, when we're looking at properties, both me and you, when we go out and see properties or even just review properties online, we're both pretty conservative with not only our numbers, but what the future of Toronto may hold. We underestimate a lot of the times, and we make sure that even if there is a potential downturn, the property that we're looking for should be able to either break even cash flow, or even, like, for example, like earlier this year, Vinay was talking about a property he purchased downtown, but then we actually looked a little bit outside of downtown recently too, because it was cash flowing a lot better. Properties were selling at 40% less, but they were only renting out for 20% less. So the market's pretty dynamic, and I think that is also why he's saying that. He's always has a pulse on the market. He's messaging me. I'm not saying like every single day, but like
no, I am.
He's messaging him right now,
on a weekly
actually.
basis. Like, he keeps me in check too, and I think to that point, what Vinay is saying is very important. If you don't have your ducks in line and your finances in check, no matter how good of an opportunity that comes, like, you're gonna have someone who comes in firm and outcompete you. And especially in this market, if someone comes in firm, that firm offer is worth much more than it was, say, pre-COVID. Because even if a deal flops pre-COVID, they can just relist it and probably get a very similar value, or maybe even more. But right now, I think people are a lot more scared about finances, deals falling through with a non-conditional offer, et cetera, et cetera. I think the most successful people that I've worked with this year for real estate acquisition have all been super, super ready. They knew exactly what they were qualified for. Sometimes it would push them to, purchase it for a little bit more, but at the end of the day, everything just turned out quite well. Wilbur, for example, is also messaging me right now on WhatsApp, and he's thirsty for another property. So,
cool. Let me just wanted to call out a couple of things that you mentioned there, Vinay. So, managing those expenses, I think, is really important, especially during this, the times that we're in right now. Similar to yourself, I actually rented for 10 years. Like, I was investing. I bought my first investment property, and I was still renting, and I did that for 10 years, buying investment properties. I think I had maybe about 5 rental properties before I bought a personal residence to live in, because the numbers just didn't make sense. It kept making sense for me to buy an investment property and not buy a property for myself, because that was really nothing more than a luxury, right? And then, the other point that I wanted to highlight was your contingency, and essentially don't over leverage, right? I think especially, where we're coming from right now with the economy potentially starting to cycle through a down period, you don't want to find yourself over leveraged and not able to react to the unknown. And this is the thing, like, we do lots of risk mitigation. We try to identify all the possible risks and come up with mitigation strategies. But there will always be, the black swans, the things that you just cannot predict, like pandemics, which come out of nowhere, which you have to make sure that you're still able to ride through. Matt, I know you're itching to say some stuff.
Oh, no, I was just going to say, get your ducks in a row, because otherwise we're not going to want to work with you. I'll be honest. Like, we're really, really, really busy, and clients who hum and ha, clients who don't have their shit together, who don't have their ducks in a row, like, quite honestly, we're not going to want to work with you because you're not ready. You're not going to be ready. So get yourself ready. It's a lot of work. Like, to get financing is a lot of freaking work, especially if you've got an investment property, or if you've got if you've got personal residence, and you've got all these you have all these property taxes, all these lease agreements you got to put together and everything. If you get everything in a row and know exactly down to the nth degree how many dollars you can spend and you're willing to spend, and then let us loose and let us help you. Yeah.
Cool. Let's pass it over to you, Chris. Then, if there was one piece of advice you wish you could give yourself when you first started investing, what would that be?
Yeah, I think that's a great question. Just kind of retrospectively looking back, probably just similar to what I think Flo and Vinay already talked about, but just taking action. Like, you're not gonna have all the answers, and I think Matt said it best. I usually talk about analysis paralysis. So if you're like someone like me who likes to analyze everything to death, to think, okay, I want to know exactly how everything's going to work out before I pull the trigger, you're never going to actually buy anything. So if I were to go back in time to just, give myself advice, I would just say, you know what, you're never realistically going to know everything and anticipate everything. Just make sure you surround yourself with the right team that has experience, the lived experience, to provide that knowledge to you when you need it. So I think the biggest takeaway for me is just, I wish I took action sooner, and just make sure you just have the right team to fill in the blanks, because you're not going to have all the knowledge. Even if you read everything and you talk to a ton of people, you're still not going to have all the knowledge that you possibly have to anticipate any risk or concerns that come up. So I would just say, just, do the best you can with knowing enough, and just, if the numbers make sense, your business model in terms of your, tenant profile, the location, the financing, everything's good, pull the trigger, and you have people around you to help you fill in the gaps. So I would just give that, pep talk to myself.
Yeah, that's great advice. You will, I'll take it one step further. Actually, you'll never know everything. The depth of what is required, or what you could learn in real estate, is huge, and there's whole areas which people dedicate entire lives to, right? Like architects, engineers, like those are their entire careers. You're never going to know all the ins and outs of what they do, but it is very important that you have, you get yourself to a level of comfort, but then you have the network to solve your problems, right? And I think that's really the very key part. So while we're with you, Chris, sorry, Matt, you want to say something?
Yeah, I was just going to say, so basically, like, yeah, I mean, at Volition, this is what we strive to do. We strive to be sort of, we want to be able to help you along your journey. We realize you're not going to have all the answers. Hopefully we can build a relationship to the point where you trust, there is that level of trust, and we can help fill in those gaps for you. But Volition actually takes it one step further. We're trying to build a community. We're trying to build a movement of people who are there to support each other, right? And that's what this Volition mastermind chat is. It's 50 or 60 active investors who are all there to support each other, because investing is a very, very lonely journey. It's a very, very lonely journey, right? And if you're so fortunate, you might have a buddy or someone that you could chat with about this, but most people won't. Most people aren't really, they'll talk about real estate, most people are going to put money into their mutual funds or RSPs or something like that. Not a lot of people are doing what we do. There's a very, very, very small percentage of people that do what we do, or even are capable in terms of the financial resources to do what we're doing. So there aren't a lot of people out there, and we wanted to create that like-minded community here. And that's what these meetups are. That's what our Volition mastermind chat is. And if you're one of our clients, if you are one of our advisory clients, or if you've completed a transaction using our services, you have access to this community, or that online WhatsApp mastermind chat.
Cool. So while we're with you, Chris, let's move on to the next question then. If you could do anything differently in regards to your investment or your investing portfolio, what would it be that you do differently?
I think one thing, I'm always just kind of dissing my dad a lot here and in this chat, but just listen to the right people. I think, there was, I think back in 2008, when the economy was, doing really well, my dad's like, oh, Chris, you should lock in your variable rate to a fixed rate. That's the smart thing to do, because all indicators are pointing to like rising interest rates, inflationary concerns. It's all pointing up for rising interest rates. So, as a good son that I am, I just kind of folded, and I actually locked into a fixed rate. But then the year after, I ended up breaking it because I refinanced. So, that was like a very expensive thing. So again, just listen to the right people for, financial information. Listen to your parents for other reasons, but maybe not all. But yeah, that's my lessons learned. Just go with variable and just write it out. Because like I think there's some stats out there that says like 90% of the time you're gonna be better off taking the variable than the fixed. So especially with investors like us, you're probably gonna most likely refinance way before your 5-year term. Instead of paying the IRD, the interest rate differential versus a 3-month penalty, it could be a huge delta between the two. So I learned the hard way. So that's my, I would do differently.
Yeah, that's and to kind of add to your answer there, one of the reasons too, not just the statistics showing that variable rates tend to be cheaper over time, when shit hits the fan, when the economy is not doing well, one of the biggest levers that the government has is interest rates. And what do they do with them? They lower them, right? They try to make it cheaper to borrow money. What does that do to your mortgage payment when shit hits the fan and the economy's not doing well? It makes your mortgage payment cheaper, right? You want to be tied to basically what's happening. If interest rates only become high when things are, when they're trying to slow the economy, right? So that's one of the advantages of being tied to a variable rate, beyond just that they tend to be cheaper 90% of the time. The other one is the average investor mortgage only lasts 2.5 years. That's until we refinance or we change our HELOC or we do something, because we can't leave well enough alone as investors. We're always trying to maximize stuff. So 2.5 years, that's it. So don't get yourself into anything that is, not going to have the flexibility to allow you to make changes that often.
Yep.
Cool. Let's go on then. Do you have anything you want to add, Matt?
Yeah, I've never taken a mortgage to maturity.
Yeah. I refinanced one house 3 times in a 12-month period. So like I'm the same.
Ming's an addict.
Yeah. Hugo and I
Okay.
are on speed dial. So let's see. Let's throw it over to you, Flo. If there's anything you could do differently with regards to your investing, your investment portfolio, what would it be?
You know what? And I'm going to amend the answer that I had from February. I'm looking at my cheat sheet right now. I think the first thing I would say, it was actually really hard for me to come up with an answer to this because, and it sounds like a weird thing, but there wasn't a lot that I did wrong because you guys gave me really good advice. And I would say not only you, but this is shocking. I know. I'm very glad this is being repeated. But by following the path, you know, looking at the materials and the blueprint you guys put together, and looking at the folks that I work with on the mortgage side, there really wasn't a lot I would have executed differently. I mean, I remember one call, and I can't remember if it was maybe Sam and Matt and Chris Darwich from the Vine Group on the mortgage broker side in the very beginning. We were looking at different houses, and for investment properties, you have to, there's no pre-approval, right? You have to get pre-positioned, which is similar to MLS listing. They say, yeah, based on your financials, we think you can do this. And my mortgage broker, Chris, was trying to protect me. He's on the phone conference line with these guys saying, don't worry, Flo, I will protect you. I'm not going to let these guys make you buy anything you can't afford or isn't sustainable to scale, because it's such a Tetris game or a bit of a jigsaw puzzle, because if you screw one property up, you can't get the next one. And so from that perspective, there really wasn't much, but I think it was important to call out about how people might do things differently. Even though I work at a bank, don't start defaulting to your home bank for mortgages because of your banking relationship. Really think about the overall blueprint of what you're trying to achieve, even if you don't fully know, at least go, if I want 2 or 3 properties, what are the steps needed to execute? And the other 2 things I'll touch on pretty quickly is I think I would tell more people about what I do. I'm very sensitive given the demands on my job of telling people I do real estate investing, and you know, will that be perceived as detracting from my main job, right? And as I build my network and think about, you know, what could I do in the future with working maybe a different type of full-time worker, scaling down that piece, doing more of the investment, how do I build my personal brand and tell my story, and also help support other investors? The third thing, which is you, because of, and it's a bit of a segue into the 4th question if time allows, how has COVID changed my perspective on things? You know, would I have made as many sacrifices? Because I did live in a lot of small spaces. I haven't had a real bedroom with a door in probably 5 years. So I've lived in like a loft space with no door. I'm living a condo right now with a sliding glass door. My next project, I am proud to say, I don't know how long I'll live there for, but it has a proper bedroom door. It's gonna have a balcony if I don't run out of money. So I think one thing is, given I'm trapped in a 520 square foot condo right now, is realizing, okay, I do need some space. In the past, maybe I should have built in somewhere along the way, you know, a 2-bedroom place for myself, just something a bit more that I could stay put in the long run. So there's always trade-offs in something, right? So that's one thing to call as you're going on this journey. How far back do you seriously want to scale on lifestyle expenses? So.
Yep. Still gotta live, right? Like if it feels like it's a huge sacrifice, then, you know, then that investment path isn't the right path for that individual, right? So we've all got to find, I think, that happy medium.
No, those are really, really good points. You know, to that last point, it's a balance, right? You have to realize especially if you have a boyfriend, girlfriend, if you have a wife or husband, that person is not only your life partner, that person is your joint venture partner, right? They're in it with you, and that person has to be on board with what you're doing. And if you're sacrificing and sacrificing and sacrificing to the detriment of your own lifestyle, your relationship, and everything else, you have to strike a balance. It's I'll be perfectly transparent. I'm going through something similar right now. Like this, where I'm living right now is a house that my wife and I we built in Riverdale here in Toronto, and this is a result of 10 years of sacrifice. I lived in a small 2-bedroom apartment in a 4-plex that I owned in the annex for 10 years. It was fine when it was, just me, I was a bachelor, and then my wife came along, and then, unexpected boy 1 and then unexpected boy 2. We just kept on running out of space, right? And
don't let the kids hear that, man.
I mean, planned boy number 1 and anyway. So, but we made the conscious decision. It's like building this house was not a good financial decision. I will tell you that right now, right? It wasn't great financially.
Oh, beautiful. That's okay.
But it made sense from a lifestyle perspective. We had made the sacrifices, and we eventually wanted to reap some of the rewards from the seeds that we had planted for so long ago, right? So there is a balance to be struck, is all I'm saying. So it's a really good point, Flo. The other things I wanted to touch on is, it's awesome. Flo has a perfect investment journey. That's amazing. Be like Flo. No, but like that's great to hear. That's there's actually no major things that you might have changed. If there's I know for myself as well, like the biggest thing that I would have done differently, I'm not on the panel, but but the biggest thing I would have done differently is I would have started earlier. I now thoroughly understand the mechanisms through which you can build wealth in real estate. I know how it works, and I try to teach this, and this is what I do through our meetups and everything. Time is the biggest factor in your success. It's not cash flow, and it's not appreciation, and it's not this, and it's not that. It's time. And you just need to get started as early as possible and let time do its thing. And it's really, I mean, if you are a Warren Buffett fan, it's really no different than what he talks about, right? The last thing that you touched on was letting people know what you do. And the reason that eventually starts becoming important is because you may eventually hit the point where you either run out of money or you can't get any more financing. Something's gonna happen. You're gonna hit a roadblock, one of these two things. And one of the ways forward for a lot of people are joint ventures. And the way to build credibility and to be able to have the right to ask people for their money is you have to be able to show a track record, credibility, and your brand. So you touched upon this quickly, but you were talking about it in the context of helping other people in their journey, which absolutely is part of it too, by talking about yourself. But the other thing is that if you want to take it to the next level and you're stuck, joint ventures is going to be the way to go. And taking on opportunities like, we asked Flo and Chris and Vinay to speak on our panel. There's a lot of other people who would have said, oh, no, I'm good, thanks. But these are the types of opportunities, like if you raise your hand or if you go out of your comfort zone, these are now the opportunities. So, now these 3 individuals could very well talk about on their, in the next time they're talking with a potential joint venture partner, hey, actually, I was a sought after speaker at one of the most prominent meetup groups in Toronto. Like that's worth something, right? So anyway, just so you, I want to get people thinking about that, because a lot of people are, they don't like getting outside their comfort zone. They don't like talking about themselves. They don't like sharing because they feel like it's, bragging or anything else. But those can be the actual steps you need to take your investing to the next level.
Yeah, and it doesn't have to be, and like I completely agree with you, Matt. It doesn't have to be about bragging. You just have to show them that you're knowledgeable and active. I think those are really the most important things. Mm-hmm. I want to keep going because we're already at 8:13, and I'm gonna go right to the last question because I think that it is on a lot of people's minds. So let me flip this over to you, Flo, since we have you here. What, if any, effects have COVID had on your real estate investing?
I had to unmute my mic. So the one moment, please. You guys have seen the YouTube video on if conference calls in real life. If you haven't had the chance yet to check it out, it's awesome. The COVID piece, I think a few things. One being the importance of tenant profiles. So I think in the mastermind chat that I think Ming and Nat had mentioned, there was a lot of chatter when all this started to go, okay, who do you think? And I think there's a question on the text chat up there about the non-payment of rent and how has it been for Volition's investors. I think all of us thought right away to what occupations do your tenants have? And I'm like, okay, in my triplex, I've got a doctor who's clearly needed. I've got a lawyer who just had his girlfriend move in, so there's 2 incomes, so I should be okay. And then the third is someone like literally a rocket scientist who works at the University of Toronto. So like I was like, oh, thank God, they should be okay. But then my mom, who has a condo in Vancouver, her tenant, I think, works in sort of an administration role, and her role was terminated. So that's where tenant profile still comes in, because from a personality perspective, she reached out proactively to my mom and said, okay, I can't pay all of the rent on April 1st, but I can split it between April 1st and 15th. And so that kickstarted me into doing some research about what the benefits are that are available. And I'm outlining this a bit because this is the work we do behind the scenes as landlords, to go, here's the links to the various benefits you can apply for. And this, and I also dug up a form, and this is where I leverage input from the group to say, here's a form that we need you to sign that acknowledges the split of the rent, but the expectation is, since the benefits kicking in, by May, you're going to be back not in arrears, right? And because the tenant profile is a professional, and so is that tenant's boyfriend, she agreed, and there weren't any issues that you might see in a different tenant profile. Let's say if they were unfortunately more impacted by some of this, or didn't have savings, or didn't want to have a good relationship with their landlord, to be quite frank. The other thing I would touch on, and I know Vinay's got a war chest, a lot of this makes me think, oh, I wish I had a war chest. And so it's always a trade-off between liquidity and reserves. And Ming's sort of grinning right now, right? Because there's probably clients with lots of money who've been waiting to spend it. And then there's me, who is probably on the over leveraged side, going like, oh, I wish I had more money, right? So for those on the fence who want to don a mask and gloves, this is being recorded, but or willing to indulge in virtual tours, like, it is an interesting time where there could be some leeway or some leverage, which is highly unusual in this market.
Yeah. Thank you for your input there. It actually made me think. So when COVID kind of hit, and April 1st was rolling around, and everybody was kind of getting anxious as to what was going to happen with their tenants. Were they going to be able to make April 1st rent? In late March, we were all chatting on the Volition chat, and everybody kind of sent out to their tenants these various emails, basically saying, hey, I hope you're doing well. If there's any problems, please let us know. We had this emergency COVID meetup last month as well to kind of talk about strategy. So I did it because we talked about the strategy. I executed on my own strategy too. I had emailed all my tenants to see how they were doing, and if they were going to run into any problems come April 1st. And I'm really lucky. None of my tenants have been impacted. One was in the middle of switching jobs already. That I knew about, but that wasn't COVID related. But what really took me back is that I actually had one tenant message me and say, hey, we're actually doing pretty good. We have an active online business. We have retail, but we also have active online business, and that's actually been doing well. And we anticipate it to continue doing well through the pandemic. Do you need help? Could I forward you extra month's rent if you're finding your business in trouble? And I was like, whoa, like I was really taken back by that. And I think that it is really indicative of the kinds of tenants that we go after. Like, they're basically us, right? They're the same types of people. They may be like 10 years, 15 years younger, and they're in different financial situations as a result. But they are, they're young professionals, or they're business owners. Like they're us, just younger. So I think that is, that was really an example of it kind of paying off. So let's go over to you, Vinay. Have you had any impacts, your real estate investing, from COVID?
I'm pretty fortunate right now. All of mine and my family's stuff in Toronto is doing just fine. We actually had 3 or actually 4 places appraised. One came actually on the higher end of what we were expecting, pretty much, peak market value. These were all done within the last 2 weeks. Another one came in about 6% lower than we were hoping for, but then the third one came in 6% higher. So it all balanced out. I still have to see what they are doing for the triplex that you guys will see later today. I'm waiting to hear back on what the appraised value is for that. So right now, nothing terrible. Pretty much the almost entire tenant profile I have for Ontario, it's kind of what Volition describes as their ideal tenants. Generally between the ages of 25 to 30, has a white collar or office type job that they're able to work remotely nowadays, even if they weren't before their companies have set them up for. I have to see about some of the other places we have not in Ontario, that, at one point I was like, I'm a genius at real estate. Yeah, let's chase cash flow. Too much appreciation, these condos, they barely cash flow, blah, blah, blah. Some of those, you get great cash flow, but different tenant profiles. So rents are all coming in for April, but we'll see what happens in May or June or July, right? So hopefully those do okay. I guess I'm also going to test the market. My original plan was to get rid of a couple condos this summer, and in the fall, and grab a few more houses. But now with, this whole COVID thing, maybe it's not the best time. That's okay. We can hold them for a while. And like Flo said, the way I actually have a war chest is because I'm hyper aggressive, but I build up decent cash reserves. So a lot of people, they'll get a property the moment they have a down payment or an equity line of credit or something for their next property, they'll go buy that immediately. If I had to right now, and also keep in mind, I invest with my family and sometimes manage some of their properties. So for instance, my parents, I don't tell them to go and buy, 30 condos or something crazy. Like if they, based on their situation, if they have a property, they should be able to float that thing for a year with cash reserves just in case, right? But I'm actually going to test the market this month with a condo that is vacant right now. The tenants just moved out, just had, some minor touch-ups done. So we'll see how it goes. If we get some okay offers, then yeah, I think it'll be great to redeploy capital. If, the market is, nobody wants it, it's at a super low valuation, I'm okay to have to re-rent it and ride this out for another year or something like that. So very lucky that right now I'm not experiencing it, but that's also due to being a little more cautious. You could have been really reckless. You'll see on YouTube, there's a ton of people who are under 40 that are super rich off real estate, but that's because they basically started investing in 2008, 2009 at the bottom of a market that's only gone up for about 12 years. So the problem with that is when you have 12 years of crazy growth, especially the last 5, you could have been very reckless and made enough money that you're probably okay right now, or maybe you have enough cash reserves or equity built up. But if say you were somebody just starting out following the advice of some of these people who have never experienced a downturn and got to start investing during a crazy hot market, that's why I tell people I got very lucky. I started investing in Toronto in 2014. Condos had basically stayed flat for 8 years, and then 2015 onward, they just rocketed. So I got very lucky. Like, I don't believe the success I have had in these 5 years will duplicate for the next 5 years as easily anyways, because you could have bought anything, right? So we'll see how this affects the market and investors going forwards. And if I'm able to get lucky, or maybe this will actually be a good thing for me because I won't have to go against 30 other bidders going no conditions. Here's 300K down, in fact, here, let me send you some cash under the table, whatever crazy things people are doing to try and get like their bid accepted, right?
Yeah, it was crazy. Like the first 2 weeks of March, I remember, me, Matt, Sam, and Ed were just like, wow, this is nuts. Like our buyers are trying to get in, they're going against, tons of other offers. Like it's actually, for us, hot markets are miserable markets. We're always on the buy side as investors. We sell occasionally, but hopefully our portfolios are growing, so we're mostly buying. And a hyper competitive market is just, it's not great to be an investor in. But yeah, so maybe, to your point, we'll see some balance coming forward, where we're able to go in, maybe we can even put like a condition on financing or a condition on inspection. I haven't seen that in 10 years, but maybe again.
Yeah, like this may be the window of opportunity, right? Everyone's always like, oh, I want to buy into a crash, or I want to wait until prices dip and then I'm going to get in. And prices might go down, or they may not. That may not be the major factor, though. The major factor is that you might actually have an opportunity to secure a property that you actually want, and you didn't have to sacrifice location or tenant profile or anything to get, right? And so we're starting to see that what was how many months of buyer market did we see? What were you saying, Ming, before?
What was that?
Oh, it's been a buyer.
Yeah, I know what you're saying. I know. Yeah. So I've seen now 3 downturns in the market, right? Because it started in 2001. So I saw the .com crash, I saw the 2008 financial crisis, and I saw the 2017, more localized Kathleen Wynne correction with the foreign buyer's tax. If I add up all the months that it was a buyer's market during that like 19 years, it's maybe like 10 months that it was a buyer's market in Toronto, where you're going in and you can say, you can condition this, condition that. It's just so rare. And, my plan personally is to buy during this time, because I know I won't see this again for bloody another 7 or 8 years. Because that's the part of the fundamental of Toronto. It's population is not decreasing. It's not changing here. So, if COVID was a localized thing and people are trying to get out of Toronto, different story, but it's not.
You're gonna see Volition, like not just helping our clients. You're gonna see Volition taking some action ourselves this year as well. We said, we not only talk the talk, we do what we say we're gonna do, what we help our clients do. And the reason we do that is because we've done it in the past, and we see this as an opportunity. We're going to be active this year, Volition. It might be a little preemptive to talk about this, but one of the initiatives that we're talking about this year is it's the long anticipated and long awaited Volition REIT. So this is where I know Flo's been. I know Flo's been trying to get us in on this getting us to do this for a while now, but Volition, we're in the process, in the planning stages right now of kind of launching our sort of Volition REIT / private equity fund, and it's something that you may see over the next few months. If you're interested, message us, message whoever it is that you're working with on the Volition team. Don't message me. Message whoever you're working with on the Volition team, and express interests, your interest in this if it's of interest to you. But we're starting those conversations now because we think that the opportunity is going to be. It's going to come quickly, and it's going to be. We think it's going to be short-lived, and we want to be able to capitalize. So, anyway, if you're an individual who's like, "Hey, man, I really wanted to do that triplex conversion, but I don't. I checked in under my sofa cushions, and I couldn't find $800,000." If you check under your sofa cushions, then you could find 100, 150, 200. Maybe it's worth us having a conversation. So that we can all be ready and have all of our ducks in a row. And if we, once we pull the trigger on this whole Volition REIT / private equity. Anyway, just this. Sorry, I didn't mean for this to be a plug. This is just to let you know, if you're an individual who wanted to capitalize on this opportunity but didn't have enough money, enough capital, didn't have enough mortgage qualification, we're at Volition, we're always looking for solutions for our clients, and this is one of the solutions that we're starting to explore. Okay, cool.
I'm gonna wrap it up actually because we're heading into 8:30 and we still want to go through the case studies. We're actually talking about like what would I buy if I had X number of dollars to invest, and going through the actual numbers behind these case studies. So I want to make sure that we have enough time for that. So thank you very much, Vinay, Chris, Flo, for participating today. Hopefully you folks in the line found it super helpful. Please, reach out to any of these folks that spoke tonight. They're super friendly and are wonderful with sharing their information and their experiences. So
yeah, I see lots of questions. There's some active Q&A on the message on the chat, so that's great. Yeah, so keep that up and feel free to message them or anyone on the Volition team if you want to discuss further. Okay, cool.
Cool.
Oh, here.
Yeah, so let's keep going then. So the next slide, Matt. We're starting off here with 350K. We just kind of picked a line in the sand, and we'll talk about what if you had 350K. Now remember, this was supposed to be at the end of our presentation in February. So the idea is you've learned about where we want to invest. We're looking in investing in Toronto in kind of our key investable areas. We're talking about the right tenant profiles. Okay, you understand kind of the fundamentals that drive real estate prices, that drive good tenants, that drive good rents. How do we actually take the theory that we spent that whole day learning and actually apply it now? So 350K sitting around. Who has 350K sitting around? And if you're reading ahead in the slide, hopefully nobody has 350K lying around, that it is in some sort of other place. Yes, there's a time and place for this much cash, but generally most people don't have this much sitting around in cash. It's either coming out of a HELOC or it is coming from a low risk investment. Maybe it's a savings account. Maybe it's like a bond fund or something that is lower risk. This is where most people get their capital from. Very, very, very few people have 350,000 that they've just been saving up penny by penny in the savings account over time. So let's go on to the next slide then. Now we have 350K. How do we execute on this? Well, what's the most important thing that we're looking to find when we're buying an investment property? If you flip to the next slide, Matt, you've heard this not just from us, but from every single every single agent out there, and it's location, location, location. Because location is the one thing you can't change, right? You have you can completely tear down and gut the house and do anything you want with a physical property, but no matter what you do, you can't change a damn thing about its locations. You have to make sure you're buying in the right locations. And we've done this work already. We've gone through and done the analysis on the neighborhoods that make sense to invest in Toronto, based on price, on rents, on distance to mass transit, on tenant profiles. And this is I guess basically our secret sauce, but this is where we invest. So if you flip down to the next slide, Matt, this is Matt's awesome graphics at work here. So the areas in red are basically the areas that we're trying to invest in, and that's places like Dover Court, Wallis Emerson, the Annex, Little Italy, Little Portugal. On the east side is neighborhoods in East York. Where you see the dollar signs there are basically places that are too expensive. So a lot of people ask, like, oh, I love the Yonge and Eglinton area. It must be great to invest there. Well, no, the houses are too expensive and rents don't keep up with those house prices. And because of that, they don't make sense to invest. The numbers don't work out. So everywhere you see those dollar signs along the Eglinton LRT there, along kind of the Yonge corridor, they're too expensive. We don't invest there. The red areas are kind of our A+ areas to invest. And then the areas that are in blue are kind of a step back from our A+. We call them like our A or B areas, depending how far we are away from those blue, from those blue sections, right? Sorry, from those red sections. So, St. Clair West, St. Clair East, the Eglinton West corridor-ish, not too far along there. And so these are neighborhoods that we're looking at investing. And this map is constantly changing. As transit changes, we're expecting the downtown relief line, for example, to materialize in the next couple of years, and that will influence this investing map. Also, as areas go through gentrification, some faster than others, that will change what we see here in this map as well. This is any questions in particular? I think somebody. Go ahead, Matt.
Yeah, well, I'll look at the questions after. Just really quickly, a downtown relief line, as you might know, kind of looks like this. It kind of goes up around Science Center, down, crosses the Danforth, goes through Leslieville, and then west. This area is an area. Can everyone see my cursor? Okay, I'm going to assume yes. This is an area right around here. Oops, shit. Around here. There's a lot of interesting things that are happening around here. Alphabet, Smart City, so Google Smart City, and crap. What was the name of this development out here?
East Harbor.
East Harbor. East Harbor is going to be a huge transit hub around here. This is an area that I would pay attention to over the next 5 to 10 years. So anyway, just like Ming said, this should be a living, breathing thing, and it's constantly changing. So that's an area that we're paying attention to. Did you say there was a question?
We'll go through the questions of the chat at the end.
Sure.
We'll plow through this then.
Okay.
So if we go to the next slide, then 350K of capital. What would if you came to me and I didn't, assuming I know what your financial goals are, this could be one of the potential things that will work out for you. So this is basically what we call a quote unquote turnkey triplex. And I use the air quotes because nothing in Toronto is truly turnkey. Usually there is a little bit of renovation that we might have to do, but occasionally there is, pretty much turnkey triplex investments. So this is a real house. This really was on the market. This is the actual numbers from it. So purchase price about 1.4. When we look at the initial investment, so this is the down payment plus taxes and closing costs, we're looking at about 333K. We expect this to rent for about $6,500 a month. You're looking at about $1,100 in expenses. After your debt service is all done, your monthly cash flow is about $500. So this is typically what we look for. Now, this is not easy to find. And when these properties come up and the numbers make sense, they go fast. A perfect example, if you're on our mailing list, was about a week or two ago, we found one of these properties on PAPE. They had an offer date set 2 weeks out. We blasted our mailing list, letting everybody know about this property, and it sold within 2 days. This is in a COVID market with no showings because this was a property where the numbers made sense. It was a little cheaper than this. Rents made sense, and people would have been able to buy that in cash flow. 2 days in a COVID market. So just good properties, doesn't really matter what's happening with the rest of the market. Investors are always investors, and they look at it, they see the numbers, they see it makes sense, and they'll execute. So good opportunities, we still need to move with some speed on.
The only thing that I would say for this particular slide, we hadn't updated this since February 1st. Interest rates are lower now. So you're probably seeing them in the 2.7, 2.8 range, probably. Investors don't get preferential interest rates like homeowners do. So you probably see them prime plus 0.2, kind of prime plus 0.3 sort of thing. So your cash, anyway, all to say your cash flow might look a tiny bit better than this. But if you're okay with this, then your best case, this is your worst case scenario, it'll look even better in a normal case scenario.
Yeah, and the other thing that we should probably touch on as well is kind of what other impacts do COVID have on these numbers here. The other thing I'd say that we may be impacted is the rents, and not necessarily the rent prices, because remember where we're seeing the changes in rent prices have really been in kind of that downtown core of condos with, you know, people who traditionally Airbnb'd and now they're flooding the market. These are kind of those neighborhoods outside of that. It's not the same demographic exactly, but right now, because there's a lockdown and because basically people aren't moving, people aren't showing, if this was a vacant property, you would have to take into consideration that you may not be renting right away, right? So if your place needs a bit of renovation, not a bad time. Construction is still an essential service. Construction is still happening. Our crews are still working. Supply stores are still open for construction crews as well. So, you know, if this is a property that needs a little bit of renovation, you come in, you've got vacant possession, take a couple of months to do that renovation. When the time that this property is ready to turn around and get back up in the market, you know, hopefully COVID might be done by then, right?
Yeah, good point. The last thing I was just going to say was, if you're considering that, capitalize your holding costs. Don't operationalize them. Basically, what I'm saying is you're going to, like, the numbers we're presenting is when you're basically hit a steady state, right? But to get to that steady state, you're going to need, like, let's just say it's renovations or whatever, or there's a time period to get to that point. And if you've got holding costs during that time, make sure you've accounted for those. But don't account for them as part of your operational costs in terms of cash flow. Account for them as part of the capital outlay upfront. Like, I'm going to need to hold this property for 3 months to do renovations and then eventually get tenants in. Consider that as part of the down payment tax, land transfer tax, and closing costs.
Let's go to the next slide, Matt. So basically what we've done is we've taken all the things that I talked about and we've plugged it into our calculator. And if you go to our website, volitionprop.com, you'll see there's a link right off there. It's our property analyzer calculator. This is simply a screenshot from that where we've taken the numbers and plugged them in here and allowed us to manipulate some of the variables to see what the returns are like on this particular property. So if we look after 5 years, and these are pretty conservative, rent increases are about 3%. And we know Toronto was on a double-digit tear for a while. I think COVID is going to impact that. It certainly has, but 3% on average is pretty conservative for rent increases. 2% inflation and an appreciation of about 5%. We can see that our cash on cash is about 3.1%. Our equity on cash is 7.1, and the cap rate on this property is about 4.6%. Obviously, the big one on there being the total annual return, which is the accumulation of our annualized cash on cash, or annualized equity on cash, or annualized appreciation on cash. Brings up this total investment to about 33% return, which is quite good for a turnkey investment. If what I just said, cash on cash, equity on cash, appreciation cash, none of those things I just said made any sense, you should have been there at our February event where we actually walk through how to calculate each of these things.
So basically you're saying too bad?
Yeah, too bad, because we don't have the time to go through and teach that today.
Yeah, we really don't.
You can go online and learn how to do these kind of calculations, but this is the basic language for analyzing properties. You, as an investor, you have to make sure you speak the language, right? You should know how to calculate your cash on cash. For example, you should know how to properly calculate ROI on a property as well. That way you're able to kind of speak the language of investors, but also able to compare your returns on a real estate investment to something else, right? On RRSP or whatever it happens to be.
Yeah.
Cool, moving on then. So let's say you came to me and said, hey, Ming, I have more than 350K. I've got, like, let's say 500K, 600K, but I'm really interested in maximizing my return. What strategy could I use to get the most return on my dollar? I would tell you to do this then, right? So this is kind of, if you're familiar with the acronym, it's pretty widely used in investing circles. It's called BRRRR. So buy, renovate, rent, refinance, right? And then an extra R for repeat if you're so inclined. But this is not an acronym we came up with. It's not an acronym that is limited to small scale real estate investing. Huge REITs that manage billions of dollars do the same thing. But basically the concept is you buy the property, You renovate it to lift the value of the property and lift potential rents. You rent it out then at its new higher rental rate. And because now you have a property that's worth more and is rented out higher, you can go back to the bank and refinance and get a good portion of that renovation cost back to you. Sometimes if the stars are aligned and your renovation has gone well and everything works out perfectly, you're able to refinance back 100% of your renovation costs. So you essentially get like a free renovation done on a home. You can take that money and you can go buy another house. So you can look up online the Burr investment strategy, but this is in particular what Volition specializes in, because we do a lot of these and we do a lot of these ourselves as investors. So Matt, if you could go to the next slide. This is a real property here. We like to talk about this a lot because that's actually Sam's property that he executed on. And we like to talk about it because I don't feel bad about showing all Sam's details, financials. So this property was in Brockton Village on Brock Street itself. That is not one of the red areas you saw in the map earlier. It's actually one of the blue areas, because I would say we're not looking at A+ tenant profiles there. We're probably looking at, A-, B+ type tenant profiles. So it's not, as I said earlier on, you're not looking necessarily for the 100% property. If you find the 70 or 80% property, but you have the skills, you can turn it into a real winner. And this is a perfect example. So list price was 118. We know that was not going to fly. It actually went for 1.3. About 400,000 renovation costs, and the ARV, the after repair value of the property, was about 1.9. We've got the closing costs, your land transfer taxes here, holding costs. I'm not going to read out all the numbers to you guys, but I think what's important to note here is, our holding costs about 55K, right? So a lot of people in their head probably aren't imagining a holding cost of that long. This is about 10 months to a year. Remember, these are big renovations, full guts. It takes quite a bit of time for us to execute on these. So we have here 55,000 in holding costs. Down payments at 20%, which brings our initial investment. So this is going to be our holding costs, our down payments, our closing fees, and our renovation. When we pull it all together, we're looking at about 764 in total costs. That's a ton of money, right? And this is actually one of the reasons that we're spinning up this REIT or GPLP, whatever you want to call it. We haven't quite landed on the exact structure. But one of the reasons we're doing it too is because, frankly, people don't have $700,000+ to execute on one of these investments. There are people out there who can, but not everybody does. Anyway, I digress. Let's flip over to the next slide, Matt. So basically, this is the cash flow we're expecting after the renovation has been completed on this property. So, we have these this beautiful property now that's been renovated, and as a result, we're able to get some great rents from this. So the basement unit, about $2,100 a month. Main floor, so these are all 2-bedroom units, I should preface. So basement, $2,100. Main floor was $2,900. And sorry, Sam, I believe the top floor was a 3-bedroom unit.
3-bedroom, 2 full bath, yeah.
3-bedroom, 2 full bath at $3,600. Now, actually, so these are real numbers. These are numbers, though, that are probably about 5 or 6 months old now. The rents may change. If we were doing this analysis 2 months ago, those numbers would be higher. With COVID impact, I'm not sure if those numbers have come down significantly from then. But I think 8,600 is a pretty easy, but pretty safe number to work with. And so these are the actual expenses in terms of property tax, insurance, hydro, gas, water, plus our mortgage. We're looking at a monthly cash flow on this place of about $3K. This is a lot. But remember, we also have a lot in this property. We have about 700-something thousand into this property. So what we want to do at this point, we want to refinance. We go back to the bank, show them our rents. We show them the potential appraised values, all the work we've done to the property. So now we can go back and refinance. So Matt, if you go to the next slide. And so then we go for the refinance. So all the rental numbers are the same here. Expense numbers haven't changed, but obviously the big change here is the mortgage. That has now gone up significantly because we refinanced back out to 80% loan to value. So now we're looking at a monthly cash flow of about 940 odd bucks. But what we were able to get is $480,000 back, right? And if you recall, I think our initial investment on renovation was about 400, but we were able to go back and take back 480. So we've not only covered our renovation costs, we've covered that and then some. I want to preface though that this doesn't always happen. It is a very ideal situation where the equity takeout would cover all the renovation costs, but it doesn't. You should never, I think, bank on that to happen.
Yeah. So just really quickly, I just wanted to actually add one thing. The actual after repaired value was on this project was actually 2 million plus. But again, we since we bank on a more conservative scenario, we were banking on an appraiser coming in only at 1.9. So those are the sort of the conservative estimates that we need to make to ensure that our business model is still going to be viable even in a less than ideal situation.
And and it's not just a made up ARV that we came up with 1.9 or the actual one being 2. We sold it, right? Sam sold this property and it sold for $2 million. That's a real value that he was able to net. So yes, the numbers work out conservatively at 1.9, and they certainly work out even better if you're selling it for another $100,000. Let's keep going on to the next slide then. So here's kind of our analysis on the returns when you're looking at a kind of a 1 year push out, and I think there's a bit of error. It should probably say 5 years,
yeah.
but that's kind of the 5 year return. So if I look at the 1 year and versus the 5 year, you're probably wondering like, oh, how come I'm returning 100+% total ROI year 1, but year 5 I'm actually returning less? So if we think about this, that actually is correct. That's how they should work. When you're forcing appreciation, so you're doing renovations on a property, the maximum value of that renovation is going to be immediately upon completion of the renovation, right? Every year subsequent to that, the property itself is worth less, and therefore those renovations are worth less. It doesn't mean you go around selling every house. That's a flipping strategy. You're not building equity in the property. But if you're talking about straight return on your investment, you'll see that most in year 1. This is also why flippers exist, right? They're trying to maximize that return. However, those flippers may not be building up equity in other things. So it's not necessarily the best way to invest your money. But this does show that difference between kind of that first year when you're doing that renovation, getting the big lift, versus 5 years later, when you're not getting as big of a lift, but you're still reaping quite a bit of return. Almost 70% ROI on this one, so that's a fantastic return. Cool. Let's keep going. So, what do you buy as an investor, as an individual coming into this right now? I don't know. That really depends on you, right? These are 2 examples of cases that we, if you gave me a hypothetical scenario, what I might say you should invest in. But unless you sit down, with somebody from this team to really understand what your investment goals are, I can't tell you definitively what the right thing is for you to invest in. And that should always be the case with any investment. If somebody ever comes along and says, hey, this is the best investment out there, they're blowing smoke up your ass, because they don't know a thing about you or what your investment risk is or how much you want to keep in your war chest or whatever it happens to be. Until they start really understanding your situation, they have no idea what the best investment for you is going to be. That said, there's tons of other, models out there. We just touched on 2 today, turnkey triplex and a full luxury triplex burr. There's stuff like laneway housing, right? laneway housing itself is not just simply adding a laneway home onto the back of your house to add another unit. It can actually be used strategically in letting your triplex happen. An example is, when you're building a triplex, there's a certain parking requirement. But if you build a laneway home, the bylaw in Toronto actually waives the parking requirement. So you could make a triplex where it wasn't possible before, because you're adding a laneway home. So it's not just adding that suite, it's how do you use that suite and the regulations around that suite to come up with a full strategic plan on the property. Other one's development, right? That could be infill development, that could be severancing of properties. That is a whole area of expertise again, and that's another place you can make money. Executive rentals, there's advanced financing, private financing, being a lender yourself. We touched on luxury triplex conversions and BRRRR. And then the last thing that we don't really have time to talk about is leasing and property management, how to make these things run. And we can certainly have a future meetup focus on that as well. Next slide, Matt. So if you want to touch on this, Matt, this is something that Matt pulled together, looking at a bunch of different types of properties that we talk about, depending on the level that you're coming in at and the amount you're looking to invest, and kind of a snapshot of the pros and cons of each one. When we had our seminar, this is where everybody kind of whipped out their phone to take pictures, because I think this is it's a great summary as to tenant profiles, the plus and minuses in terms of headaches, returns, affordability. So Matt, do you want to touch on this in any way?
Yeah, where it really comes down to is there is no perfect investment. It's all going to be about trade-offs. It's going to be what's important to you. Again, it's not always ROI. I'll tell you that right off the bat. If only chasing ROI is your guiding light, you are going to be sorely mistaken, because you're going to make a lot of missteps along the way. And so you need to think about things holistically. You need to understand what the risks are. You need to understand, what is the biggest risk in my business? Is it the market? Is it interest rates? Is it this? Is it that? Volition has done that legwork for you. And we have determined that tenant profile is the biggest risk to you in Ontario. That may not be the case elsewhere, and it isn't actually elsewhere. In Ontario, we have very, very friendly landlord-tenant laws, which means if you're compromising your tenant profile, you're introducing risk into your business. Maybe you're okay with that. Maybe it's part of your business strategy to have that risk, but it's part of your operational excellence to mitigate that risk. If that is the case, fine, great. Maybe another type of investment is right for you then. So anyway, this is just a quick snapshot. 99% of you, or 99% of investors, will invest somewhere on the spectrum. There are others, obviously, namely large multifamily. So that'll be like 12 plexes, 20 plexes, 100 plexes, apartment buildings, what have you. There's also commercial. So there's, retail, there's office, and there's industrial, warehouses, and there's mixed residential commercial. Those 99% of you will not invest in that. You'll invest in one of these. So I could expand this chart, but it wouldn't be relevant to you. What we're looking at here is a slice of all the different business models that are relevant. Luxury triplex conversion we just talked about, turnkey triplex we just talked about. We didn't talk so much about condos and pre-construction today, but we do understand that not everyone has what it takes in terms of the financial backing, the resources, or even the capacity to take on a triplex or a luxury triplex conversion. Because quite honestly, they're not as easy as condos, right? Like, it's a house. Things go wrong with the house. It always will. There's no sugarcoating it. It's a business. If lifestyle is the number one important thing to you, then maybe luxury triplex conversion is not for you. Or if you do, then you hire full service property management or something to that effect, right? But this is, or for a lot of people, they just don't have the financial resources to get into something like that. So they need a stepping stone approach. And that's where condos and pre-construction condos come into effect. You know, we talk about freehold or low rise or ground oriented units a lot. And that's what houses are. That's what triplexes are. We do have a number of condos and pre-construction condos in our portfolios personally, as well as, you know, our clients. It's something we don't talk as much about, but if that is of interest to you, then there is an opportunity for that. And I'll tell you right off the bat, 95% of the condos and 98% of the pre-construction condos out there suck as investments. They just don't make any sense. It's really, really hard to cash flow. They, you know, the prices are too high relative to the rents, or there's just a whole host of stuff. But it is part of our spectrum in terms of the various investment opportunities, condo and pre-construction condo. Where this is the highlight of this slide is really to illustrate where small town investing comes into play. Small town investing comes into play because people immediately gravitate towards small towns for the price. They go, oh, it's cheaper. Because it's cheaper, therefore it's less risky. Right? Wrong. That is not how risk works. What was the saying you want to say, Ming? Price versus value. What did you say?
Price and value are two separate concepts.
Price is what you pay.
Price is what you pay. Value is what you get. And
Yes.
that's not me that said it. That's Warren Buffett.
Oh, it wasn't you.
Yeah, I wish I was that wise,
You wish?
but I am no Oracle of Omaha.
No, no, you're not going to say when there's blood
Oracle
in the
of
streets.
Ontario.
Yeah, right. But anyway, small town investing, like this is, we're not speaking out of turn here. We have experience in small town investing. You know, across the Volition team, we've invested in a bunch of small towns, and we all regret it. And you know, that's not to crap on people who do it, because it is a business model that people can be successful at. You just need to know what you're getting yourself into. And if the reason you're getting into it is because you think you're mitigating risk because it's cheaper, that's not the right reason. Okay, so tenant profile is one of the biggest reasons, because, you know, we touched upon it earlier. A lot of those investors and those landlords are shaking in their boots, and a lot of them are getting slaughtered, and a lot of them are like, WTF, what the hell do I do right about now? Because their $800 to $1,000 or $1,200 rentals attracted a certain tenant profile, and that, you know, temp worker or retail, or, you know, just something where there wasn't as much stability. Those people don't have a lot of reserves, and those people were people who may or may not be employed anymore right now. So anyway, I put together this slide prior to COVID, but it rings true even more so not post-COVID, current COVID, mid-COVID. Tenant profile, sorry, it sounded like you were going to say something.
No, I was just laughing.
Okay. Tenant profile, okay, short-term headache, long-term headache. So I've graded these things across the spectrum in terms of all these different business models. Basically, small town investing ends up being a headache always. Like, and it's literally because your tenants suck. For the most part, you know, there's going to be exceptions to the rule, of course, but for the most part, for the amount of time versus, you know, like I said before, that's not only about ROI. There are two other concepts. There is risk-adjusted ROI, and there's headache-adjusted ROI. And unless you're paying hedons to all three, and you don't have a full scope and a full picture of how you should be approaching your investing. You're not investing, actually. You're running a business. And so this is why, you know, you could buy a share of Google or whatever, and it's the same as buying a share of Apple or whatever. You're not managing the damn thing. Here you are. It's your business, right? people get into this. They get into this for the wrong reasons, and one of the main reasons is because it's cheaper. But I do understand affordability is a big thing, and they also get into it because of cash flow. They think, oh, I can cash flow out there way better than I can cash flow here. Great. Is that $500 making any difference in your life right now? Anyway, the point being, at the February 1st event, I've stepped people through the Volition multiplier effect in terms of how you grow your portfolio, how you, during the acquisition phase, how you reach a certain point, and then you're in the hold phase, and then you reach a certain point, and then you're in the divest phase. The idea being getting to free and clear as quickly as possible with as little risk as possible, with as little headache as possible. Free and clear with your portfolio, smaller portfolio, but totally free and clear, massive cash flow. That is when cash flow actually makes a difference. This $500 or whatever these people are getting out in, these buttfuck nowhere places, that's not game changing. It really isn't. And I can say this because between us at Volition, we've invested in Hamilton and KWC and Sudbury and Edmonton, and we all regretted it, right? We've all brought our portfolios back here. So anyway, coming back to this, pros, cons, overall, as you can see, we understand that there's a place for small town investing. We just don't think it's here at the, for Volition and for Volition clients. So anyway, that's a kind of summary of this.
Yeah, thanks, Matt, for going through that. Let's skip down to slide 53. I don't think we have time to go through this 10K, and we presented it at a previous meetup.
Is this it? What's
yeah,
53?
yeah, this is it. So, now what? Now what do you do if you wanted to take a next step? And this is, where I would encourage people to take action. It was brought up multiple times by our guest panel today, and we're not feeding them things to say or anything. It's completely them coming up with themselves. But
although I think Vinay's asked for $500 for his kind words. So
yeah, I'm glad Ed's saying that. But yeah, sign up for advisory, or go to our website and look at some of the previous meetups. If you're new to the meetups, they're all online. You can watch the videos. But I'd encourage you to sign up for advisory. Send an email to info@volitionprop.com. We can schedule a session with you and just talk about what those next steps would be for you personally. Next slide, please, Matt. So our next meetup is actually May 3rd, which is a Sunday. And what we will be doing, because our plan always for this February 1st event was we take people through the theory, and then we apply the theory, and then we'd actually take them to a property so they can see with their own eyes and touch with their own hands what the hell we're talking about. Unfortunately, we can't physically bring you there now because of the COVID lockdown. So what our plan is on May 3rd to take you via Zoom. I will take the camera there, and Ed's going to take a camera out to another property. We're going to go on site to to two triplexes that we're in the middle of converting and show you exactly what we're talking about. You can see the construction process. You can see what the fire separation looks like. You can see how resilient channels are. You can see the floor plans as to how how we decided upon this. And it's very, it's kind of taking the theory now to the next level where you're actually seeing it applied. So we're doing that May 3rd. So keep an eye out to the mailing list. We'll send it out to everybody when we have the actual scheduled time. And that's what we're going to be doing May 3rd. Next slide, please, Matt. And then we have another meetup after that, May 20th. And we were talking earlier as well today about letting other people know about what you're doing, right? This guy is a master. His name's Dave Dubois. If you haven't heard about him, he's kind of he's like a Russell Westcott. He specializes in raising funds. He runs a podcast called Property Profits Podcast, which I was a guest on a couple of weeks ago. I think that podcast is coming out in 1 or 2 weeks. So again, look out for the email blast if you want to listen to that podcast. But he's creating kind of a special topic on raising capital during a pandemic, during the crazy times. Like, how do you still get people interested in wanting to invest in you? So I think it's going to be a really good guest to have speak. Next slide, please. And that's it. We like to land off with this one. If you can, who can do it, you can do it. We've all been beginners before, and we're confident that everybody can execute. That's it. We'll stick on the line for a while. I think like the Volition team will be here. We'll take some questions now, and we'll start. I know the chat's been really busy, so we'll go through that and maybe answer some questions. If you want to stick around, you're more than welcome to, or you can drop off at this time then.
Hold on, I'm launching a
Whoa,
poll.
what's this?
I'm launching a poll. Yeah, that is all you need to do. Quick click. That's it. We just want to know how you're liking this new Zoom meetup format. We don't get a lot of feedback because everyone turns off their damn screens, their damn webcams. I only see like 7 people or 10 people, and so we don't really get a sense of how people are liking the format. If they're liking it, if they're not liking it, if they, and also, what do you want different about it? We're just guys who know something about real estate who want to help. We're not event planners. We don't really know what the hell we're doing with this whole Zoom thing right now. If you have feedback or comments, be like Cecily. Cecily gave us like 3 pages of feedback from our February 1st event. So that was amazing. So that was great. So the rest of you need to step up and help us too. and also tell us what the hell you want to learn about, because we don't do this for the good of our own health. We already have our portfolio. We already have, we're already investing. We could continue just doing this, but we want to help. And that's kind of the mandate for Volition. So if there's something you need in order to remove roadblocks and obstacles, and in order to move forward, let us know so we can help you by addressing that in a future meetup. So anyway, yeah.
Cool. Let's open it up to the floor then. I'll let you take the first question, Matt, because I'm going to go to the washroom.
What's the first question? I don't even know where it is.
I don't know. There's some questions in the chat, and if anybody wants to unmute themselves and ask a question.
Yeah, just unmute yourself. There's so much writing. Does anyone have a question? No one has a question? Okay, well, keep on. I'll just start at the top then. I'll just work my way down until someone has the confidence to unmute themselves and turn on their webcam.
Matt, there's a question in the chat that you can scroll from on the investment for the REIT. Sounds like there's a lot of interest.
Was there? Really? Okay, what was the question?
It was from me, actually. Can you hear me?
Yes. Hi.
Wait,
oh, hi.
There's noise here. Let me put on my headphones. 1 sec.
Okay.
There we go.
Okay, go ahead. Yep, go ahead.
My question was, you were talking about the REIT, the possibility of that coming up in a couple of months. And what are you guys, and I guess it's maybe in its infancy and you're still planning, what would the minimum investment for that look like? Do you guys have any idea at this point?
Oh.
Okay, because I'm just thinking too, like, okay, what would that look like in order for me to get my ducks in a row?
So again, this is very, very much premature. To be honest, I was debating even talking about it or not, but I just thought, okay, you know what? People are going through a hard time right now. Sorry. The market, they might think that there's an opportunity, but they don't have enough to actually capitalize on it. So let's just hear people out, see what reaction there is, and maybe take it from there. That's the only reason that I mentioned it. We didn't have a slide about it, for example. We really weren't planning. Okay, so our ideal, I think, is going to be maybe 150K minimum investment. Mm-hmm. And I think it'll be probably across at least maybe five other investors. That's what we're thinking at this point. We may lower the requirement to 100, I'm not sure, or we might increase it to 200 and then take on less investors.
Really early days, like,
Hard to
you know,
say at this point.
it's hard to say at this point, and you know, we're just kind of fleshing out what the best like corporate structure may be, like what protects people too. Because if you think about it, like if it's like a traditional JV, for example, everybody kind of has equal ability, which sounds great, but can be a big problem if you have one person who's like, who could screw everybody over, right? So we need to make sure that everybody's kind of protected through the process. So
I don't think this is going to be a joint venture structure. I think it's going to be probably more like a private equity and a GP-LP structure, which is a general partner, limited partner, where Volition will be the general partner. We will shoulder all the risk. We will be the ones taking care of the financing and everything. And then people come in as limited partners and they would buy what are called units. These are not units like the basement unit or anything like that.
Right.
These are just units of this GPLP structure, and their downside will be limited to their original investment. So if you put in, you know, one of the things with the joint venture is that if you put in a bunch of money with someone and you're the money partner and things go awry, you can lose more than just your original investment. But the way that we would want to we're thinking about structuring it is we'll shoulder all the downside risk, but you know, as limited partners, you'll see the upside risk or upside reward rather. Yeah, so I'm just high level. We're thinking about 150K, but TBD.
Okay, thank you.
Just to follow up on that, would you guys consider making it RRSP and TFSA eligible? Because there are ways to structure it that way.
Yeah,
probably not. Just because for us to be able to meet requirements for RRSP and TFSA, like to be a registered investment, it's kind of beyond our skill level for like round one. Maybe if, you know, this takes off and, you know, we start doing many more investments, there's still ways that maybe you can do it, but for the actual like investment for itself to be RSP eligible, that's kind of like getting into a security at that point, and that kind of is beyond.
Yeah, I mean, the one possibility, and again, can't promise anything because we don't know what the structure sort of looks like at this point, but it could be RSP second mortgage lending. Right. So there's other ways you can do it. You can actually take your RSPs, lend it out, and maybe Volition is in a position to take that on as a second mortgage, maybe to cover the renovation costs or so. Anyway, there's lots of things for us to figure out, but that is one way. It's not RSP eligible in the sense of, you know, you're investing in the REIT or the private equity, and that's eligible, but it's taking your existing RSPs and then lending that out to Volition as a second mortgage. So which through your RSPs. Anyway, there's lots of different ways you can do it. We're not sure which way we're going to go yet. Good question though. Thank you for the insights. Oh, and what I forgot to ask, I don't know if you're comfortable actually saying this, but is there a number that you feel you know, minimum investment sort of makes sense? I need to get a pulse on people as well.
So I personally done 2 of these. One unit with one company was 50K minimum, and then the other was 25K. Yeah. So their objective might be a little bit different. I think they capped it at, I don't remember how many investors they capped it at, 30K for one project, but it's definitely a lot lower than what you guys are thinking about.
Yeah, yeah. Ours, to be honest, we don't want to take on that many investors. There's definitely, like, we know a ton of these people who do stuff like this, not in the GTA. No one does this in the GTA. Sorry, not GTA. No one does this in Toronto, because first of all, no one can make this work in Toronto. Volition is probably the only entity, literally, that can make this work in kind of the downtown freehold ground-oriented unit sort of thing. Where you start seeing this a lot is like Waterloo, Hamilton, those areas. And we know a bunch of people who all do this, and that's where you see the 25K, 50K, you know, the cost of entry is a fraction of what Toronto takes. So that's, Wafa, was there a minimum requirement that you're sort of thinking about? You're on mute.
Oh, right here. Yeah, I was thinking 80K, 100K is actually what I was.
Okay, good to know.
Yeah.
Good to know.
Great, thank you.
Guys, I know it's a little premature, but do you guys have a timeline? Because for us, if we're investing money in one project, we can't, our money's kind of stuck somewhere. So what's your timeline if we're interested in the Toronto market?
Tomorrow. Yesterday.
Don't have
We will let you know. Do we have your contact? It's Ling Chung.
Yeah, it's somewhere on the mailing list. Yeah.
Okay. So Ling, if you don't mind just sending us an email just so we have it. It sounds like you're keen. We will have a few more conversations internally, and hopefully we can give you a little more guidance. You know, if we are actually getting things off the ground, we can keep you apprised. Actually, that's true of anyone. If anyone on the line is like interested in this and they want to be added to, let's say, a separate mailing list that is kind of keeping people apprised of our progress as we work towards this, send us an email and tell us specifically we're interested in the Volition private equity fund.
Okay. What email do you want us to respond to?
Yeah, I'm just gonna write it down here. I'm gonna respond.
Have I spoken to you before? Are you Dominic's friend?
Yeah, I'm Dominic's friend.
Oh, right. Okay, fine. Nice meeting you virtually.
Thanks
okay, I got your email. I saved your email. Yeah.
Okay, great.
Talk about the read back then.
Okay, cool. Thank you. Any other questions about this REIT before we move on to anything else? Okay, I am going to mute you, Wafa. Don't take it personally. Okay, so no more about the private equity. Any other questions? Okay, I'm just going to start going down the list then.
Actually, one of the questions someone asked is about what do we feel like investing in like Ottawa or Waterloo market?
Oh, didn't they see my slide?
Yeah, I think where the clarification might be around is do we actually consider small town? We basically consider everything that's not Toronto or Vancouver small town, which is, not really true. People do exist outside of Toronto, but we have been investors in a lot of places. Edmonton, Hamilton, KW. First 10 years I was an investor. I was an investor in Waterloo, specifically student rental properties. I maybe don't take as harsh a tone as Matt. I can't knock it as much, but I went through the same thing, and it wasn't necessarily that students were bad tenants. They're not malicious. Like, they're not out to screw you. At least that was the case with Waterloo tenants. But it was more that they're students, and it's their first time living away from home, and they don't know a thing about it, and they don't pay rent on time ever. Not because they are like, oh, I'm going to hold my rent money back. It's more like, oh, I've got a midterm in 2 weeks and I wasn't even thinking about paying my rent. Without fail, because I still have a couple of these student rental properties, but without fail, every first of the month, half of them haven't paid. I'm just sending them a friendly reminder, hey, please pay. And they all eventually trickle in. But if the expectation is that, a student is going to take care of your place, pay rent on time, in the same way that you would when you were, let's say, working as a professional in your 20s, it's not. It's vastly different. They're kids, right? So is it great cash flow? Yes. But the very sad thing is the value of the property. When I did a full analysis and I looked, when I finally learned how to do proper financial analysis on the investment property, and I looked at my Waterloo investment property, and I looked at, I had a townhouse in Mississauga at the time, and this was the first time I was doing, a proper financial analysis. My return on the Mississauga house, and it wasn't even the best one in my portfolio, was double that of my student rental property. And it was just mind blowing that, I had not done this properly for almost, at that point, about 8 years investing. And I had not understood the proper language of real estate investing and how to analyze properties properly. And that's when I started focusing more on Toronto and buying properties in Toronto and exiting the student rental market in Waterloo. Yeah, what do we think about them? We obviously we were there. We don't, but we understand that it has downsides, and for our investment goals and purposes, the downsides don't match with what our intended, what we want to get out of our investment portfolios. Not to say you can't build a successful investing outside of Toronto. It's just for us, it didn't align.
You can do this analysis yourself. You don't have to take our word for it, right? There's ways for you to determine these things, and those things are by looking at the fundamentals, right? So you look at the economic fundamentals, and we've talked about this a lot before. GDP growth and job growth and population growth and blah 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 blah. Do it yourself, and then realize though that that's still only part of the story. The other part of the story is, who's your tenant profile going to be, and what are the economic prospects linked to what's the industry in that town, and how risky is it? Ottawa, it might make sense for people. People might make the argument, hey, this is super stable because government jobs aren't going anywhere. Hey, if you believe that, all power to you, right? We have done this analysis, and our conclusion was Toronto, because of diverse industries, because of the tenant profile, because of the growth prospects, because of 100 different reasons. But you can do that yourself. Talk to other investors. We're not the only, we just happen to like Toronto, but there's a lot of people who make Hamilton work, they make Waterloo work, they make Ottawa work, or wherever. That's not to say that their investments are any inferior, just using our perspective and our grading profile, if you will, they didn't match with what we believe to be a superior investment. Okay, any other questions? Okay.
There's some questions about legality and legal triplexes, legal duplexes. So let's touch a little bit on that. Are all our properties that we do legal? It depends on the investor. We have the ability to do them all legal, and there are advantages to doing a fully legal triplex or fully legal duplex. Primarily that being around, financing, right? Because if I've got a fully legal property, all the financials that are behind that fully legal property can count towards my mortgage qualification, and therefore whatever subsequent properties that I'm buying. It's fully legal, which means I can't be shut down by the city because I'm doing everything above board. But there's a big cost, not just cost in terms of getting it to, going through community of adjustments, getting all the extra architectural work done, but it physically costs more to do a fully legal property, in that you need proper fire separation. And that includes, burn rating of drywall. That means HVAC. That means interconnector fire alarms. That's just extra stuff that you need in your property in order to make it fully legal. Does that mean that's the right answer for every investor? For some, it is, right? And we do a lot of legal conversions. For some, it's not, right? Not every property, it makes sense for the investor to do a fully legal conversion. They may do a duplex and maybe have one extra unit, or they may not do it conforming at all. The reality is in Toronto that so much of the multifamily units out there aren't fully legal. That is both a good and bad, because that means that if you put together a property that's not fully legal, Toronto is such a housing crisis that hasn't changed with COVID. People still have nowhere to live. Our vacancy rates are still very low. The city of Toronto is not trying to shut down these places actively. They just don't have the manpower, and it's not in their best interest to shut down these places. The bad, I would say, to having a not fully legal place is it's not fully legal. So if you have complaints, there is a potential that you get shut down, right? I think our job is not to tell you which one you should do, but to give you all the pros and cons, make sure you're fully informed. And then as the investor, you have to figure out what your risk level is and what the right thing is for you to do. So I don't know if that answers the question.
I think one of the main thing that most of the investor is worried about is the insurance, is the house insurance, right? You know, if shit hit the fan or, you know, the house caught a fire, then are you still, you know, insured by the home insurance, right? So what we share with our Volition client or even our properties, right, our investment property, we have a full disclosure to our insurance company, right? We let them know, you know what, this is a 3 self-contained unit in this property, not separate entrances. It's going to be like a 3 different family will live there, and chances are the insurance company will give you a different rate for, you know, that suit your investment property, like a triplex setting.
Yeah, so that's how we ensure that we're covered from a liability perspective. And the other thing is we always make sure that we are looking at broad form coverage. So broad form coverage means that it's covered unless specifically excluded on the insurance policy. So that means that the insurance company can't come back later and be like, oh, hey, we didn't know about this. Actually, sorry, I answered the application form truthfully, and it's not specifically excluded on my insurance policy. It is covered. So that's why it's important to have a good insurance broker. I think insurance was something that was an active topic on today's Volition Mastermind chat on WhatsApp. But anyway, that's just an addendum to what Sam was saying.
I have something to ask. I just recently with the COVID thing, when you have like self-contained units, what if you have 3 units and basically share the same forced air gas system, like a communal system, and basically you're sharing the air. So with the COVID thing, you know, they're not really self-contained. So I thought that was a really interesting point of, you know, you could share everything else, but you're sharing like a forced air gas system. It just, you have a one main system in the basement and you basically have zones, but the air itself is being shared between ducts. So, yeah. So is that really self-contained in that way?
Well, for our fully legal units, they'll have separate HVACs. So if we have 3 units, we actually have 3 HVACs. So 3 furnaces, 3 air conditioners, and it's fully separated. We do this, one to meet actually fire separation regulations and one to meet air recirculation requirements. So that's why we have the fully separated HVACs. So in that instance, yes, we are actually fully separated. If we are looking at something that is not that, right, where we're looking at like a shared, we wouldn't be fully legal at that point. Right. So we may be self-contained. I don't know what the exact definition of self-contained is, but yes, you know, the air is not self-contained in a non-fully legal unit.
Yeah, Daniel, when they talk about self-contained in normal real estate vernacular, that means separate entrances, separate kitchens, and basically your own bathroom as well. It means that you're not sharing your living space with anyone. That's the typical understanding of self-contained.
Yeah, that's that confusion, right? So also there's a difference between duplex and a secondary suite, right? Yeah. So that's a thing that a lot of people get confused. They're not the same. They're not synonymous. So I think Min could talk about that. Yeah.
Yeah, that's one of my like buttons. Is that people use those terms interchangeably and they're not interchangeable. Like a duplex is a separate legal definition from a secondary suite. A secondary suite is a City of Toronto thing. A duplex is a Ontario building code thing. To get to triplex, you go through duplex to get to triplex. You can't go to secondary suite and then go to triplex. Requirements are different. Ceiling requirements, fire separation requirements, all those things are different between secondary suite and duplex. So Duplex is harder to achieve than secondary suite. Just, yes. Thank you, Daniel, for mentioning that. That is definitely one of my hot topics.
And there's another one that people get mixed up with, fourplex and a quadruplex. That's also a different type of they're different as well. They're not synonymous as well. Because I've seen I looked at Hamilton where when you have the zoning, they separate those two as two separate terms, like R1, R2, R3 zoning, and they're different. So that's interesting because some people interchange them, and they're not the same as well.
Yeah, we have to be super careful when we're using terminology,
right.
Especially when that terminology has like zoning and legal requirements behind the terminology. So yeah, it's a great point, Daniel. Let's see, are there other questions? Flo, I didn't say Vancouver was a small town. I said other than Toronto and Vancouver, everything were small towns. I saw Vinay cringe when I said that.
Are there any questions in this thing? Okay, here I'm just gonna talk then. Since no one has a question, I'm just gonna talk.
Matt, way up earlier on, I think people asked about Volition clients, like how many tenants didn't pay. If you guys have a sense of what, let's say, % of people didn't pay, or the vast majority did. I think we talked about it in our group chat as well.
Sorry, what was the question?
The April 1st, so out of the client experience. Sorry, I'm walking back to the laptop.
Oh, yeah.
April 1st, yeah. What proportion of tenants have paid, basically?
So I think we're really high. So based on the feedback that we've got through Volition Mastermind Chat, which is about 40 to 50 active clients, I think we only had one who lost their job for April 1st. And that was actually not within our our scope of properties to buy. Like, this was something that investor had bought, slightly different from what we traditionally advise our clients to buy. We have some vacancies. So, both me, Matt, and Sam were talking about it earlier. So we're each running one unit vacant right now. It is harder to rent simply because nobody's going to see properties because there's stay-at-home order. They are not, even if they were to go out, they don't really want to move now. Moving companies are closed. Rental's difficult to do. So if we've got a vacancy now, it's going to stay vacant probably for a little while until some of the restrictions are lifted. But in terms of overall impact to us as investors, it's been really minimal. I'm cautiously optimistic. I'll see what happens when May rolls around. But right now, everybody's okay. Everybody's employed for the most part. I don't think we've seen any real fallout. 50
some odd investors on that mastermind chat.
Hundreds of doors.
Yeah, that's got to represent at least 200, 300, 400 doors probably.
Yeah.
And so anyway, just to give you some sense, like that's a pretty good sample. that's a pretty good sample. So I mean, it's anecdotal and it's biased, of course, but it's biased for a reason because we all invest in, well, for the most part, we all invest in the same way if you're a Volition investor. So anyway, yeah, so whatever that percentage is, it's very, very low. Definitely single digits, maybe even below 1%.
Yeah, I think we're actually below 1% right now. Yeah. Now, hopefully it stays that way. Hopefully COVID's temporary and, it doesn't make a massive difference, but that is what we saw for April 1st.
Yeah. So this is it's a good sign. Okay, anything else? Right, okay, I'm gonna talk about, since we're just talking about legality, I'm just gonna switch topics because it's something that just came up because I was talking to a client about this recently. It was around grandfathered status of a property that he owns. And so basically, We're talking to a client about a fourplex that he currently owns, and he's a guy who, pretty experienced investor, but just doesn't know the ins and outs and doesn't know the specifics. So this is where we came in. We had this conversation with him, and we were just helping him understand the concept of a grandfathered status for his property. So we're going to be kind of going through this process with him and helping him determine this. But just so you know, there was I'm trying to remember the exact year. There's a bylaw enacted in like 1986, I believe. It was a zoning bylaw for Toronto. Properties that were used as, let's say, duplexes or triplexes or fourplexes or whatever, prior to that, and if they've had continuous use, non-interrupted during this entire period, and they're not technically zoned or allowed for units, as per today, as per if you looked on Geo Warehouse or Land Registry, or you know some of the places you might go to see if it's sort of like zoned or legal triplex. You can make an application to the city if you know what you're looking for a routine disclosure of the city archives. And what you're looking for is something to prove that this was used as a triplex prior to the zoning bylaw change. So they enacted some bylaw and they said, okay, only certain properties, only properties that meet the, adhere to this bylaw on an ongoing basis are legal triplexes or whatever. The ones that are grandfathered, they're called legal non-conforming. They're legal, they don't conform to today's bylaws, but they met previous bylaws. So the fact that Toronto's just changed a bunch of shit impacted them. And so the city recognized that, and they said, okay, you know what, we'll recognize the previous status, we'll grandfather that status on an ongoing basis, as long as the property has continued to be used like that, which means if a family moved in and turned it back to a single family, and then someone else changed it back to a triplex, no go, right? And there's a bunch of stuff that they'll be looking for in support of an application to the city to recognize that grandfathered status. They'll be looking at hydrometers, they'll be looking at city records, they'll be looking at tax assessment rolls. I found this really interesting. Way back in the day, back in like the 50s, they used to actually have the tenants' names down on the tax assessment rolls, the property tax assessment rolls. So we all get our assessment rolls and we say, okay, this, the city thinks our property's worth this amount. It's not, usually doesn't mean crap. It's usually way off. But, usually we don't really pay attention to it too much, but it's what our property tax, monthly property tax or annual property tax is based on, the assessment roll. So back in the day, they used to list all the tenants too. So if you go back into the city archives, you can actually find old historical documentation to show, hey, this was used back in the 50s as a triplex. And then you have to be able to show that every 5 years on an ongoing basis until present day. That is one way. Another way is an affidavit from a previous owner that it was from the previous owner that was used as a continuous use triplex. Another way would be to check the City of Toronto Building Department building permits, and if it states anywhere in the building permit that it was 3 self-contained units or triplex or 3 residential units or something like that, that might be enough to go back to the city and say, hey, I want my property recognized as a legal triplex. Anyway, just when we were talking about legality and stuff, I thought it was an interesting tidbit. I like these tangents.
I could support what you're saying. My situation was exactly that. When I applied for get the building permit, I was flagged 17 items that violated the building code. The biggest one was that they didn't recognize it as a triplex that I bought it as. It was legal non-conforming. So what I did was I went through basically the city directories, and went back. And you could see each year of the directories. It shows whether there were people living there, like number of tenants, different names. So I had to use that with the zoning examiner. I didn't have to apply for anything. I spoke with the zoning examiner directly. I said, look, this is the situation. You know, I have three parking spaces. I have this, and this is, I have the front showing 3 units, and they basically recognized it. So you're right. That's how it was done.
That's awesome.
Yeah. So it's
Was
true.
that done during the pre-zoning review?
Yes, correct. When you get the zoning notice, they basically flagged it, and then if you go through that, you know the development levies, they're like, it's over $100.
They're about the development. This is all in an effort to avoid development charges, right? Like if you're currently a single family, and you know this gentleman that we're chatting with, it was just recognized as a single family, and he's got 4 units, and he's like, okay, well, what would I do? What would it look like? Hey, dude, you've got 4 units in here, 2-bedroom units each. Those development charges, if you were a single family applying for 4 self-contained or for a 4-plex or whatever, a building permit, you have to pay the development charge from 1 unit to 2 units, 2 units to 3 units, 3 units to 4 units, 3 development charges times $60K each. That would have been about $180K in development charges.
Yes. My neighbor actually paid, I think he went from a single family to a triplex, $130,000.
Yeah, it's about $60K per 2-bedroom unit. I think that I know that property. I think it was number 19.
Yes.
And that was the one that where they had a 3-bedroom unit as well. So I think that was probably like $60K for the 2-bedroom and maybe a bit more for the 3-bedroom.
That's right. Correct. So so what you're saying is true, and that's how you can do it. You go back to the city, the directories. And by the way, the roll thing, that doesn't count. My property tax itself, like you said, is true. It shows the past tenants. My property tax shows it as a 4-plex. It won't recognize that. So I'm just giving you let you know, like that would not even listed as a 4-plex, property type 4-plex, and it shows you four units. So I'm just letting you know the zoning examiner will not recognize that.
I think
ironic, isn't it, that they're both coming from the city?
I know.
It's like only the government.
Exactly.
You have one part of the government saying it's a 4-plex, and those are the people you're paying taxes to.
Right.
And the other part of the government not recognizing it. It's
yeah, I know. That's so funny. Exactly. I'm paying it as a 4-plex for the taxes, and you don't recognize this. It's true.
Yeah.
This is
you're paying more taxes because it's like on your property tax, and it would be recognized as a 4-plex.
Right. So,
you gotta love the government sometimes.
So I mean, I think none of these things are a slam dunk. It's all in an effort to try to just convince the city. So, and it's obviously going to depend on who you're working with there too, like that actual zoning examiner, whether they're going to recognize this or not. You're just basically trying to put together a case to do so, and you're trying to present as much evidence as possible. Like, hey, on this property assessment roll, you can see 3 tenants listed on this thing.
Right.
Hey, I've already got 3 hydro meters. You're trying to put together that case so that it's believable. Right? So yeah, it's a tough thing, but you're great for you. It's not always a successful outcome. In fact, it's very rarely a successful outcome. So it's great to hear that you went through it. It was just top of mind because we were just talking about zoning, and we were just having this. I was having this chat with a client.
Well, believe me, my heart dropped when I saw that zoning notice saying
yeah, I can imagine.
17 items and contract being 17 items of the bylaw. It was just, your heart just drops. So I pared it down from 17 to 11 to 5. That's why I had to go to community adjustment. And then, of course, COVID came up, and March 25th, it got postponed. So that was the one that was the next one. So they postponed it. So I don't have it. I need to go through community adjustment, go to a 4-plex from the triplex to a 4-plex because of parking violated because they weren't lighting.
Yeah.
So that's what's happened.
And parking, they're quite tough with parking too. So
Actually not, because I attended the meeting. They were actually, I've seen a few cases, they said they passed it. So,
Oh, that's good.
The community adjustment is not as bad as people think. I think from what I've seen, they basically passed 94% of everything that comes forward. It was very rare when someone gets really greedy, when they get really high density that they want to. They were really good. Actually, I have to say, in City of Toronto, they were really good. The 5 panelists, they were quite good. So
Toronto's a lot more interested in. Go ahead. I was going to say, Toronto's a lot more interested in making density happen, right? Like,
yes, exactly. They're really keen about gentle, what do you call it? Gentle intensification.
Gentle densification.
So what they're saying is that what I'm trying to do is I'm not changing anything from the exterior. So you get the neighbors upset. You try to just change what's inside. And they like that. You don't change the
extensions, increase of massing, changing of the massing of the building. That's where, and really, you're right. Like the COA passes way more than they decline. And if you get a rejection, it's typically because, not always, but typically because it was an outrageous request. And that's where it's good to have your architect or a private development planner on your side so you analyze the neighborhood, see what's likely to be passed. So there's lots of ways to mitigate that risk. The other one is neighbors. Freaking neighbors can really screw you.
You'll have to tell us sometime about your neighbors, Matt.
I still have PTSD. I'm not talking about that.
I've got to drop off because I have to get back to daddy duty, but you guys are welcome to continue.
No, I got to go too. I have 10 more seconds. Is there any one thing that people want to say or ask before we go?
If not, send us an email. Like, you know how to get a hold of us. I'm Ming at volitionprop.com. Matt's Matthew. He won't answer. Send it to Ming at volitionprop.com or info at volitionprop.com. And you get a hold of us that way if you have any questions.
Sam as well. It's
Sam Ed
at volitionprop.com, Edward at volitionprop.com. Just make sure you don't send it to me.
Yeah. It'll bounce back.
It'll bounce back. Yeah. Mailbox full.
Thanks everybody.
Thanks, guys.
Take care. Stay safe.
Bye.
All right. Bye.